point is we do want to back up the bus on great sustainable investments, or, you know, but we're not also, you're going to hear tomorrow about energy transition, and I'll be a little controversial. We can't just stop today on fossil fuels. We have to find, in fact, that's what, there's a gray area. There's a way to take natural gas into gasoline without refining. And so, huge carbon footprint, but we're not black and white. Some people are black and white on these issues. That takes me to politics. We can be political but not partisan. We're going to talk about a lot of these issues today and tomorrow. So, same thing, no pitching, discussion, teaching, learning. Congress could use that. Show one slide. Can you? I can't. Not sure if it's back or front. You can't do it. No. I bet you could. I bet you could. Gary's from the Midwest, like I am. We get things. You know, we figure things out. Give us a shovel, a hoe. All right. It's not. Yeah, little. Well, that's. All right. Fair enough. I was just going to let people know about us because we're a little different, but this is good enough. We're going to keep this slide up. We're a little off the clock, but what we're going to do today is talk about geographic. How are you going to, you know, we talked about Europe going through another virus variant, you know, lockdowns in Austria for those who aren't vaccinated. We're going to talk about, you know, Asia was like, China was the darling 9 months ago, right? And now, we talked about it today. It was really interesting insight. So it's really wherever we are in the world, how should we allocate and think where's the growth, where are the risks, and you really probably can't. You don't want to avoid China. You want to just optimize how you access whatever it is. Same with asset classes. Same with industries and all the rest. You've now talked about we have our calendar up. So if you go back to that last slide, we're going to keep it there, Gary. I appreciate it. But so when you see yourselves right there, many of you are not in this room, like Roberta and Zach Nasser, who's in Dubai. Vadim was supposed to be here. He may show up. He coming in from Hong Kong, Vatsala. Yes, this is recorded, by the way. You can hit the got it. Richard is supposed to be here, but if to the extent that you are here, we're going to go through and ask you two questions. It's a two-part question. What excites and scares? I like scare than excites, but you can answer whatever combination about X. In this case, it's about where should we be investing globally. So can I turn to you, Roberta, because I see you there, and talk about, because you have exposure to emerging markets, or whatever you want to talk about. What scares and excites you about investing globally today? Can I leave it to you, Roberta, to kick us off? I'll carry on. I apologize. Those who are on Zoom, we're trying to figure out giving you the ability to speak from there. We figured it out earlier this morning really well. Anand, can I suggest is there a phone? Probably not. This is not a conference room type situation. Or can I do this? Helen, can you come up and talk about Africa? Kick that off. The third conference that Eddie attended, he was thrown up and I said speak about cannabis, and he did. And those who are on Zoom who are going to be speaking, we'll get to you in due course. Actually, you can take any. I met Helen through Sheila Driscoll.
Hello, everyone.
From Driscoll Farms, and we were so lucky that she introduced us to you, and you traveled with us throughout the Midwest, right? But you come from Nigeria, and you can talk about your impressions of that. But I'd really like to hear if someone's going to invest in Africa, how should they think about it today?
It's a very simple question. I'd say we are young people that are out there right now. looking for a better life, to better what's happening right now back home, and considering what's the government is doing right now, it's not really encouraging, but people like us are coming back to impact. And the best way we can is by liaising and merging with people like you. And the only way we can do that is trusting us as people who are able and capable to actually do the job and get the job done to actually impact back home. It's a huge group of people. For example, I'm in the fashion industry, and we produce and manufacture for not just local brands, but international brands as well. If we can be the next China and Nigeria, why not? If we can be the next Sri Lanka as a growing company, why not? Right now, we are looking to partner up with people locally here as well, smaller brands, bigger brands, corporations who make uniforms, and the only way we can do that is by having people like you trusting us to actually do the work and do the job the best way we can. We are encouraged to change in the narrative that you hear in the news. People like us who have moved back from London and have explored the world, coming back is a bit difficult, but the only way we can actually make that impact is being able to make the connections, make the encourage people as well, and get the job done.
Excellent. We're gonna. Should we test it on them? Do we?
Hopefully it's on.
Okay. I think those on Zoom. All right. We'll do it in another minute. We're gonna give us a second, Roberta. We're gonna pull up another person from outside North America. Actually, Gary, you invest in emerging markets. Can you want to say a few words about allocating to outside of North America? Yeah. This is how we roll, Gary. Yep, just come on in. No, right up here. Yeah, and have a seat, Helen. Just,
right. So I did
did
not come prepared for this. So I've been investing in emerging markets for over 30 years. I was introduced to the group by Simon Vine. We met in Russia in 2003. Talk about serendipity, and we stayed in touch. So what can I say? I invest in public markets, and there's been, if you ask me, possibly 3 stages of investing in emerging markets. One was when the concept was invented. And basically somebody came up with the idea is let's replicate a bond index, make an emerging market equity index, we'll put in the countries, we'll get weights, and it's going to look like the S&P 500 for emerging markets. And that was a great idea because what you had was a group of countries with homogeneous problems. Volatile currencies, bad governance, a lot of family-owned, publicly traded businesses, but were really being managed for the families, not for the minority shareholders. And we transited that stage, I would say, from the late 80s to about 2003. And we went through several crises, right? The tequila crisis in 1994, the Asian crisis starting in 96 towards 98. Russia had its problems in 98. Brazil had problems in 2000. So did Turkey, Argentina, a million times in the middle. And then orthodoxy came to emerging markets, helped by a very, very benign global and financial economic cycle. And some countries graduated. And so I was speaking to one of the attendees, Richard, before. Pre-2003, in the 90s, when all this really started, no central banks in emerging markets had orthodox economic policies. By 2003, about 75% of the places that were investable had some kind of orthodox economic policy, managing inflation targeting, and trying to control spending and the likes. And so we went into the global financial crisis with this new scheme of, some had converged more than others. And I think now we get to a point where emerging markets as a label for investing is not that apt anymore, because the same way that we started back in 1987 when the index was created with homogeneous problems, we have a lot of different problems. the demography, so remember BRICS back in 2001 or 2000 when they came up with that. There was, it was about demographics, it was about the power of the consumer, it was about using best practices and emerging. That group of countries, maybe one made it, and maybe it went backwards now. So that's the way I think you should look at emerging markets. It's a whole new set of individual opportunities. It's not one homogeneous block that you want to invest in because the dollar is going to be weak or because the Fed is going to raise rates. It's got to be looked at in a much more specialized, targeted, and opportunistic way.
Perfect. Yeah, stay there. So, can we, Roberto, you want to try it again? Hold on.
Guys hear me?
Yes, there we go.
I got a nice delay. Sorry about that, but anyway, well, nice of you guys to have me. Sorry I'm not there in person. Probably would be more technically adept if I were there in person. But anyway, my name is Roberto Brzezinski. I manage a global emerging markets growth equity practice for a South African firm called Capital Works Investment Partners. And nice to see all of you, at least virtually. Some of you I know for decades, some of you I know for several years, and some of you I don't know, but I look forward to seeing you all in person in future events. Like Gary, I also have an emerging markets background for almost as long, although in my case I'm a private equity investor with some private debt as well, historically. I agree that emerging markets is a kind of monolithic term that should be broken down into different kinds of markets, from frontier to more investable markets. I think importantly today, why does it make sense to even look at these markets versus other markets? Everybody knows that the U.S. is so overvalued at this point that it's kind of eye-popping. Of course, we all hope it's going to stay that way, because otherwise our personal portfolios are going to be seriously problematic. Europe is looking kind of sclerotic, so that brings us to emerging markets. China was, a darling for a long time, but now for a combination of maybe valuations, geopolitical reasons, that's less of the case. Although, as I like to say, any company that doesn't have a China strategy is not a company you should be investing in. But having a China strategy is not the same as necessarily being in China, of course. But so if you kind of look around the world, you've got your emerging Europe, your emerging Asia, your emerging Latin America, and of course you've got Africa as well. All of them have opportunities and threats. We're focused as a firm on all of these emerging markets, but with attention to the what I would call middle income or more investable markets, meaning and why do we think about that way? Whether you're a public equities or a private equity investor, having rule of law, having some visibility into exchange rates, having fiscal policy that makes sense. These are all important items, and whether you could make a predictable bet, whether in a private sense or a public sense at a company. That doesn't mean that money can't be made in the frontier markets, and people have, of course, done that. But whether it's when it's a really high beta environment, when there's a background of let's say currency or fixed income defaults, for us as a fund, that's not something that we're comfortable making those bets. I think what I would say to you today is that that kind of high valuations for growth has not been lost on a lot of different investor kind of ecosystems. So that means that not only is the U.S. expensive, but emerging Asia is super expensive today. Most of it, particularly North and Southeast Asia. We're seeing more relative value, and that's definitely relative, not necessarily absolute, in companies coming out of both emerging Europe and emerging Latin America. So if we had to tell you what we see in the short to medium term, that's what we would see. But of course, things can change, and these very geopolitical kind of gyrations that are going on now may actually create more value for investors in Asia down the road. We'll see. So that's my commentary. That's my question.
That's great. Let's just get a few more perspectives. I know on him, are you on? From Johannesburg?
Hi, Mark. Yes, I am.
If you could just, maybe you can mute yourself, Roberta. There you go. Go ahead and just give a quick thought on Africa today.
Perfect, yeah, thanks. And you know, it's exactly, I think, as Roberta said, you know, if you look at the USA, Western Europe, and the like, fast-scaling, saturated, and still lots of opportunities in there, but everybody's talking about Africa as the next big market. This year alone, we've had 7 unicorns, depending on how you define them, of which 4 have been in fintech, more than half of them also in Nigeria, and that's what's a small number in the bigger landscape. It's only getting bigger. So I think, you know, we have the largest population as a region, the youngest population under 35, and from the lens which I look through gender lens investing, the only continent that has more female entrepreneurs than male, who are typically, you know, more educated, have a track record, but not enough capital being allocated to them. So right now for us, that's the full focus. A lot of activity here. I think within the first half of 2021, Africa as a region just, you know, far surpassed the targets, but even the capital raised in 2020, even during COVID times, and that's here to just grow even further. So, you know, really at the moment, anything that's on the continent, anything that's tech-enabled with a specific fintech lens and health tech and ed tech, that's where we see a lot of the attention, a lot of capital being pointed and targeting perhaps, you know, 3 to 5 more unicorns within the next 6 to 12 months. So that's been an interesting time for us.
Great. And tomorrow we're going to talk about inclusion, and you also lead a fund focused on female-led companies, which is, we'll talk about that tomorrow. Zach Nasser, as you sit in Dubai, maybe your perspective, not just you're investing outside of the UAE and the GCC, but maybe how do you look at the GCC as a market where people should be allocating?
Thank you, Mark. Yes, our activities have been focused in the U.S., but I will share what's happening around me here in
nice background, but you need more light in your face. Sorry.
Am I not visible? I just tested it.
Visible, but the background's more visible than you. It's okay. Keep going.
Okay. So what I was going to share, like among the families around me here, there's chase for a couple of things. One is private debt and private credit right now. Even though among like the Arabic families, you know, sometimes there's distancing from debt, but there are a lot of, you know, Western families based in Dubai that we are friends with, because everyone's just given up on loans, not loans, on bonds at this point, so they're trying to find some secured form of debt. Another thing, you know, that's you know, Sharia compliant and it's hot right now is warehouses. One flavor of it, like Amazon warehouses around the world. You know, I heard a story about one in Milan that got a bidding war sort of behind it, because a lot of families see it as a way to you know, track technology, but at the same time you're still holding a traditional asset like which is real estate. Similarly, like power plants in Europe, like different types, solar, wind. So there's been appetite for these sort of things in the last couple of weeks, last couple of months also. Real estate locally, I've seen different, you know, tastes. Some are dropping residential and going for commercial. Again, developing warehouses in strategic places. But I know another next gen actually that's doing like a purely residential strategy. I think he acquired close to $100 million of like different apartments and villas, and like he's gonna just like start landlording over these like assets, so nothing like sophisticated, not like a fund or anything, just like plain old vanilla, just like owning real estate here. I have some comments on Africa. I have some friends that live here, but their businesses are in Africa. And they've been having trouble getting credit themselves, so what they've been doing is accumulating real estate in the UAE so that they take debt on the real estate and then use it for their businesses in Africa. So that's been an interesting thing I noticed. And these are like families that are like many hundred, $1 million worth of revenue in their business, but still credit this stuff, because I guess they're in Africa, even if it's Western Africa, which is meant to be, developed. Last thing I was going to share, also related to Africa, is like NBA academies that are like up and coming. Like Africa is becoming, a sourcing funnel for talent for the NBA. So there are things developing in that area.
Is that because the NBA players were just in town or something? Is that NBA or NBA?
NBA, yeah.
Well, let's.
So those are my comments.
Great, thanks. And if you don't know, Zach, and you do look better on my iPad, so it's our screen here, is a big contributor to our philanthropic and impact side, and you'll see him a lot tomorrow. So with that said, any questions or comments? And I'm sort of Donahue, I'll move around, let's give it another 3, 4, 5 minutes of where we should be investing. Maybe you heard from Roberta, Helen, Greg, Zach. Questions, comments? Steve?
Hey, Mark, I've got a question. It's Rob here. Can you hear me?
It wouldn't be a session without a Rob Color reading questions. Go ahead, Rob, go.
All right. I don't think you're okay. Roberta, I'm going to maybe focus on you, but whoever wants to chime in, I saw him as well from Africa. You've been in the emerging markets for some time. I was curious, Roberta, has governance improved, just given sort of the rise and the adoption of technology? I'd be curious as to, and then also to the extent ESG has kind of come in with respect to transparency. What are your thoughts there, Roberta?
Well, that's a great question, and Rob, you and I have been going to the same events for it's probably almost 20 years now, so that's pretty amazing. Glad you're still interested in these markets. They aren't always, they tend to disappoint as much as they elevate. But yeah, I think overall, at least in the middle income markets that we're focused on as a firm, I think you have seen. You guys still hear me? I'm hoping that you can. You have seen some improvements in governance, although again, from our point of view, we would always advocate, particularly if you're making a private investment and even a public investment, it's best when you have a company that may have operations in a market, but it is domiciled, headquartered from a legal sense, in a reputable offshore jurisdiction. So for instance, like an Indian company might be domiciled in Singapore, a Latin American company might be domiciled in Canada, an Eastern European company might be domiciled in Luxembourg, and that always makes it easier. So if there is some kind of legal issue or litigation, you're in a kind of Western standard jurisdiction. So, but that being said, I think you are seeing in a number of these markets improvements. You're seeing, roughly speaking, a reduction in corruption in some of these markets. You're seeing more of an understanding that foreign investment is important. For the economy as a whole. So, and again, that's part of how we're differentiating between markets. We want to see countries that have demonstrated, in their governments and over a period of time, so it's not just one administration, but different administrations, that foreign investment, whether financial or strategic, is a key element of their continued economic growth. So I think you have to look for that. You have to look for those that, it's kind of self-selecting, those governments that are looking for foreign investment are more likely to be, reaching out and to be more friendly and to be more public about that. And that's, I think, an important distinguishing factor.
I have a question for Greg. When it comes to the emerging markets, when you're thinking about the emerging markets, it's not one, where are you looking for opportunities, or are there any themes that are the dominant themes you're following?
So I think the most exciting themes are the same ones that people are looking for in the developed markets, right? So and that's why I was referring to the individual cases. So it's the innovation themes, the disruption themes, and then together with that, it's what's being done that's different than whoever set the pace, right? So the Amazon equivalents outside of the United States, what do they look like? What do they do? And you'll see that there's companies that have come together that, they leapfrogged, right? The same way that emerging markets leapfrogged landlines, because in a lot of these places you couldn't get a landline for your life, no matter how much you tried to pay for it, and went directly to having better cellular technology than we get here. I get better reception in Africa than I get in Penn Station. I'm not kidding. And so I think that's where you want to look at. I agree with Roberta in terms of you got to look at the governments, and that's kind of the thing about investing in emerging markets is governments tend to get in the way a lot, but sometimes they help a lot too. And so the combination of those two things. So it's not a particular country. So when I said the low-hanging fruit in emerging market has been harvested, I kind of look at it, and just going back to the previous question too, is a very long, not E maybe, but an SG story that we've been arbitraging for the last 30 years, right? S and G was really bad, and it got a lot better, and there still has a long way to go. E is coming into the picture, and you know, it's going to be interesting, and the companies that can provide solutions economically will be in favor. But the low-hanging fruit in terms of country selection, that's gone. I think that's gone.
So look, we could talk about this for hours, and we will and we should. But we're going to shift over to asset classes from geography. So let's thank our panelists, the impromptu panelists in particular. Thank you. Okay, we're going to talk about venture, private equity credit, public markets, and to the extent, actually, since we have some latecomers, maybe Christian, can I call you up? I'm going to ask you to talk about two things. Europe, because we just, as a segue, and venture and debt. So we will kick off this discussion. You can grab one of these mics. Introduce yourself.
Hi, can you hear me? Hi, I'm Christian Czernych, and I'm... Okay. I'm Christian Czernych, and I'm running a royalty fund for software firms in Europe. We are located in Vienna in Austria and in Stockholm in Sweden. We are, well, pioneering to build up a credit market for tech firms in Europe. The market for credit in tech is really underdeveloped in Europe, and it's just starting to emerge. And we started a couple of years ago to test and see whether it could work to use royalty financing to fund software companies. Back in 2017, when we started with that, nobody was really understanding what we were doing, but we were very convinced that the market would go in that direction. We've seen that in the US, that there's a lot of revenue-based lending out there in the market, and of course also in the pharma space and in the mining space. It's a model that has been established for decades, and we just thought that the cash flows in the software industry are very similar to the cash flows in the pharma industry. You have no operating, so that the cash conversion is extremely high. There's high operating margins. They typically have negative working capital, and there's no capex. So it's quite easy for those companies to give a share of their revenues in exchange for funding. Of course, the big advantage for the firms is that that the funding is non-dilutive. And we have been doing this now for a couple of years, and now the market is really picking off. We see that a lot of entrepreneurs in Europe start to think not only equity but also debt when they think about how they can fund their growth, and so that's really a great opportunity, and we are there in this market.
Thank you. I thought it's an interesting strategy because it's a way to play venture safer, and you don't think of Europe as a source of innovation, but a source of a value play, which is sort of, and when you do venture debt in the U.S., a lot of times you're betting on the funds, and there'll be follows, and these guys they're not going to let this baby die, whereas you're playing it on fundamentals, and so it's an interesting way to play venture. with the debt side, and have access to your. So I'm intrigued. Now, having said that, I see, someone was saying, I think it was Roberta, the valuations that are out there in the U.S. markets, including bulge bracket private equity, is pretty insane in some ways. But part of it, Steve likes his world to invest, but with that said, Craig, your fund, if you can come off mute, is in the lower middle market, and you've developed a nice track record here in the U.S. North America. So if you could just sort of show your perspective from the lower middle market private equity world. One second. I don't know if you're muted or we've muted you. 1 second, Craig. Go. Floor is yours.
Mark, can you hear me?
Yes, go for it.
Okay, great. As a quick introduction, I'm Craig Enstein, based in Los Angeles. I trained in Bain under Mike Milken in his private buyout organization. I run Corridor Capital. We're a lower middle market operationally transformational private equity firm backed by institutional and family office limited partners. Purchase little leaders, not yet institutionalized, buying around 5.1 times EBITDA, build infrastructure, scale and sell for about 10.1 times EBITDA. My view of the lower middle market is that the world has over time commoditized, and that the generalist financial engineering private equity business is a tough one to run today. We're now in the age of specialization, and different kinds of models we see in the small market would be those with a deep sector focus, such as healthcare or industrial services, those with situational expertise, such as distressed or corporate carve-out models, people with transformational operational engagement models, which would be a solutions-oriented approach to adding value. A really interesting firm is one that does technology implementation, which would be Bertrand Labs, as an example. Infrastructure institutionalization, which is a two-stage ownership model, where you invest in leadership businesses that haven't yet scaled because they lack certain infrastructure. You build out that sustainable, scalable architecture, and then you take them through scaling. That's what we do. There are those with consolidation models, like Audax and CI Partners, who are really phenomenal at building out that capability. And then lastly, the other thing we see in the market are folks trying to differentiate by serving underserved markets, such as underrepresented minority targeted categories or business managers, or in our case, women-run businesses. About 40% of our CEOs are women, which is a market that is grossly underserved by private equity. So in summary, what we're seeing is folks trying to, over time, put a lot more specialization in and around their business models to pick a lane, and even within that lane, pick even deeper sub-specialization in order to be able to buy right, add sufficient value to defend on a risk-adjusted basis their assets, and ultimately exit with appropriate returns for the asset class, which I would argue for the small end of the market need to really be a mid-20s type of net IRR to investors.
Great. Thanks, Craig. We'll have, it's time for a question. We've had a long discussion of the importance of liquidity, and then the public versus private, and then, some of the FANG stocks versus small caps. Fortunately for 85, actually probably more like 105 weeks in a row, we've had Stephen Burke. So he always says, why are they investing? They're so enamored with this private alternative funds and investments. So make the case for the publics, either U.S. equities versus vis-a-vis private, not necessarily emerging markets. That's a different discussion.
Okay. I think the world is, as Greg pointed out, in the emerging markets, there's not any one market anymore. So I think you're investing in ideas, whether it's public or private, shouldn't matter as much until you need liquidity. And we never really think about liquidity, usually until it's too late. And we've had that as our experience in this industry forever. So I think you want to balance your portfolios with the ideas that are the ones that are going to attract capital, obviously, but you also want to have your portfolio blended to allow for the liquidity that comes. And I think sometimes we forget, what the public markets for the last 10 years have done about 16% annual return. It's not what you get in venture deals or other deals, but there is a consistency to it that is pretty attractive, and we've all benefited from the low interest rates. I think one of the worries when the punch bowl's pulled, we're going to have some real valuation issues, and I think you want to make sure your liquidity is set up to accommodate that. And in a lot of the discussions I hear from families, I'm not sure the enthusiasm for the less liquid stuff is balanced to what the liquidity needs will be over time. We're all chasing the same ideas, the same themes that are going to drive where capital is going to flow. Public-private venture really doesn't matter. Debt or equity shouldn't matter as much. These are the areas that are going to drive the economy forward. We're going through massive transformations globally, and you want to have a piece across all. And we think that the other thing that's important about the public markets is there's massive capital creation going on there. And just to give you a sense, I mentioned this at the 11 o'clock session, but 9 companies in the S&P have moved from 2013 of a market cap of $1.2 trillion to $13 trillion. That's the FANGs plus Netflix and NVIDIA and the like. Tesla as well. So you're seeing a handful of companies driving it, but they're also bringing a lot of companies along with it, both public and private, creating new opportunities. So I think we just have to keep an open mind to it. And what I would say in the public space is, I don't think indexing, because of some of the valuation issues, is where you want to go right now. I think you want to do the same thing you're doing in your private portfolio and your public portfolio, which is identify the opportunities, focus on them, and go after them. And I think that's the way you would play it in this environment. And what I would worry about is whenever the rate regime changes, and it could be sudden, that's when you're going to be concerned about your liquidity needs. And that's when you'll know, as Buffett says, who's swimming naked when the tide goes out. So we just want to keep balanced in what we're doing.
Fair enough. Is there one more perspective that Ivana Park could come up, is growth equity. So we've had venture debt, opportunistic equity, we've had the publics, and we've had the lower middle market. Actually, Eddie, if you could come right over here. You can talk about Europe if you want to. It's a little hot. So tell us about why should we be in, venture equity?
So particularly in the light of impact, by the way, which obviously this should be and is an impact conference. So I'll answer that question in that light. And Stephen just mentioned there are massive transformations going on across the globe, particularly in tech. And tech, we feel our thesis is enabling growth for the rest of the planet for the next decades to come. So that's where we invest in. And arguably the most important stage of that is nascent companies with nascent technologies. We just had COP26 and with a lot of negotiations there. You can say it's successful or not successful. But all that, all those investments and all that CO2 reduction is based on the premise that technology will figure out a way in which we can better and more cheaply sort of reduce CO2 from our lives, which is obviously a massive, massive, massive challenge. That starts typically with small companies. Health, for example, same thing. A lot of the future growth in that sector will be done by companies that are right now coming out of the PowerPoint presentations of young entrepreneurs. Blockchain, same thing. The average CEO in the blockchain space is probably 24. I mean, that's maybe a high estimate. It's young nascent industries that are poised to grow and that are solving real issues that are there or that will be there. We believe this is the time to invest in venture. No, I mean that's essentially it. There's a big difference in late stage venture and I think growth venture. Okay. And growth venture, you see valuations in growth venture coming earlier and earlier on. That's one of the challenges we have. Some people think they're worth 100 million when there's an sure. 8 slide PowerPoint presentation. But but
I thought that was Canada. Okay.
That's a challenge. But at the same time, there's a lot of those companies that will, in 10 years, dominate the NASDAQ.
Well, you're sitting right next to another fellow European, Austrian, Stockholm. You were in Leiden. I studied in Leiden. We love Europe, right? Maybe talk for a second. The European opportunities. Where are the best opportunities? Is it debt or equity?
Well, I mean, of course, the equity market is always interesting because as long as digitization goes on and we are just in the first quarter of the whole process, of course, equity is interesting, no doubt about that. I'm just always a little bit worried about the valuations. Right now, the interest rates are really low, and the inflation is going up a lot. And I don't think that we see the real inflation rate that is going on at the moment, and we don't know it might rise. So interest rates might rise, and then of course that has a detrimental effect on the valuation. So that would be my only concern. But otherwise, of course, equity is extremely important in Europe, and the debt market is interesting because it's just emerging. So we are much earlier in the cycle than in the equity market, and there's a huge opportunity to build like a massive firm or massive firms providing debt to European tech companies. And that's the opportunity that my firm Round 2 Capital is pursuing, and I think that's interesting. We have a protection against inflation. We have a protection against potential decreases of valuation. But yeah, and Germany, just to finish off on the story in Europe, I mean, Germany is of course the heart of Europe, and they have been quite slow on digitization, but I would not, I would bet on Germany quite a lot because they are awakening now. There's a new government coming in, and they will massively invest in digitization. The same for France. Actually, France is also really, really interesting, I would say.
And by the way, we'll be back in Europe. We're worried about what's happening in Austria right now, but we'll be there. Maybe, Craig, what do you think, lower money market private equity versus growth equity that Eddie's investing in, or both?
Well, so I'm a former Forbes 400 family CIO, and to me, it's about asset allocation. At the end of the day, you're building a series of investments in the alternative space. I wouldn't pick one or the other. To me, you're building an allocation, and the allocation in a perfect world is engaged in selecting what I'll think of as value-added strategies, regardless of whether they're real estate strategies, growth strategies, private equity strategies, distress strategies, et cetera, because ultimately I think we're in a time where the nature of the interest rate environment and some of the economic dynamics of coming off of this completely unprecedented extended expansion means that you have to be in places where people can buy things a little bit more intelligently and then use various tools to maximize risk-adjusted returns. I think growth is a fantastic place to put capital. There's very fundamental and recorded systemic changes that are happening in the underlying way that we do business, the way that we live. I serve on the board of Naspers and Prosus. We're one of the largest investors in the internet in the world across both emerging and developed markets. And there's so many places to pick in growth, but to me it's about being targeted and ultimately backing individuals and groups that have differentiated access to deal flow as well as skills to make a difference in those assets within the growth strategy. And then within private equity, I would say the same, is you ultimately have to curate manager selection where people have a competency to really prevent the inherent risk of material downside that's going to come from the volatility that we're going to continue to see, and frankly, I think, see more of in the markets ahead. So I think it's a both answer, Mark, and I think it's really about curation of finding the value add elements and the preferred access and ability to make a difference in businesses within manager selection.
Bless you, Cedric. So, questions on asset classes? Yes, Jaspreet.
It's related, but not really in asset classes. Thank you, Mark. This is a question for all of you. Almost every panel I've ever attended related to investments or emerging markets, there's always a comment that we want to support more women founders because there aren't enough women as CEOs or founders. But I've been hearing this for a long, long time. I'd love to hear your opinion. Is it because is it a deal flow issue? Is it a deal quality issue? Is it a deal confidence issue? Why is the number so low?
So I think it's a question that crosses all markets. It's not unique to emerging markets. It's all markets. I think it starts with who has the bulk of the capital. You have a bunch of white men, predominantly, who have the bulk of the capital, and when you ask those folks to design a risk-adjusted portfolio, they commonly are going to find people that look a heck of a lot like themselves. And that might be academic pedigree, it might be history of their activities in their life, or whatever their preferences or priorities are. There's a lot of like for like that happens in the world, and it creates a very challenging model for people to break through. And so in a perfect world, people think of it as an underserved market, and that I mentioned in some of my comments earlier. And if you think about it from just a pure capitalism perspective, the reality is, if you think about a woman CEO and you place her side by side with a male CEO, the woman CEO on average had a lot more challenge to get into her position than the equivalent man. And by definition, if you just think about it mathematically in a very agnostic way, by definition, for her to have gotten to that position, more likely than not, she's superior to her average male counterpart. Yet, capital doesn't seem to tell that story. In venture capital, we see about 3% of the dollars going to women-founded teams, or teams that include women founders. If you look in private equity, the number's closer to 7 across. Oliver Wyman did a study very recently that looks across Europe and developing markets.
Craig, can I just,
the US.
Sorry to interrupt, but maybe Hema could speak to that because she has a fund dedicated to this thesis.
Sure.
And explain what, Hema, explain what 535, what's behind that.
Sorry?
If you could explain the name of your fund.
Sure. Yeah, so, just first to reiterate what Craig said, I think spot on, right? Until there are more people who look and sound like me at the investor decision-making tables who are allocating capital, no one's going to point money my way, right? This is my lived experience, and we can dig deeper there. But, the second part of it, so all the reasons you spoke about, the unconscious bias, where the money is coming from, those are that's well-versed, and we see that. But I think we don't talk about two things. One is the opportunity, right? We have to separate this. Everyone thinks about gender and underrepresented founders as only impact, So of course there's impact, but if people are only looking at it through an impact lens, of course, people invest into funds because they want to make money. There's money to be made, returns. And, I have a compound with a female, Africa and the like, and it seemed like a charity case a little bit, right? So whatever I have left over, I will then allocate to women or underrepresented founders. And until we change the narrative about where the money is going, I don't think it's going to get there fast enough. And that takes me to the opportunity. So my fund is called 535 Ventures, and it's just that. We know if we add more women entrepreneurs to the African ecosystem, we could see up to a 5% GDP uplift. And that's actually largely wholly true globally as well. That's 2 to 6% globally. And that's really by leveraging the 35% higher ROI that you typically see in diverse teams over all male-led teams if the playing field was level. So if they had access to the same resources, capacity, networks, and the like. There's study after study being published about, and I think Craig, you mentioned this as well, how women generally perform better I don't have the luxury of winging it, right? I have to be credentialed. I have to prove my track record 5 times over. And that's why, because we don't have the same fail fast, fail forward luxury, if you will. But it's still, until we convert and I'm going to be a bit unfortunately, until we convert the lip service to actual allocation, we're not going to see the change. Someone has to take the first plunge. Somebody has to, bring it to life. And the female conversation is not just a women conversation. It's the male allies we have who will start, walking alongside us to make this happen.
Yeah, and I'll just put one compliment to Hema's point. I agree with her 100%. Ultimately, capitalism rules. And at the end of the day, I can tell you as somebody who has 40% of my portfolio in women, we're kicking butt backing women. And what's going to happen is people generally don't like to lead. They don't want to be the nail that sticks up. And so as they watch people like Hema and us and others make a lot of money as capitalists backing women for no altruistic reason, but for purely capitalistic reasons, they will follow because money likes to make money. And so over time, this will get resolved because the proof is now out there and you can't put it back in the bottle.
One more comment on that one. I think on a sort of human level, it's a total travesty that 3% of the money flows to women founders. On an investment level, that's an excellent opportunity. So we look particularly for underserved opportunities, meaning geographically. We look at the Midwest, Canada, the South, parts of Eastern Europe, where we think there's less venture capital. We do the same for women-led companies. The valuations are probably like for like lower and the quality better. And we do it for minorities as well. I think a similar trend, that I don't have the numbers in front of me, but a similar trend holds as well. So it's an excellent opportunity, I think, for any asset class, but particularly for private growth venture.
And tomorrow, inclusion is a focus area. And really, it's part of what we call 360. You can't have your best view on investing, whatever the asset class or opportunity, unless you have all the perspectives there. In fact, I was looking for this book. Peg Wyant, she was the first woman in corporate America. She was Jack Wyant's wife. And we want to do a proper fireside chat. But, how can these white males explain how to sell diapers, right, to this market if there's no woman at the table, let alone, all the black and brown and all the other perspectives or geographic perspectives. So that's, okay, last question, Erica, because Simon Vine's at the airport, and I've got to play a video, but go ahead, speak loudly. The question is, how many, okay, ultimately 2, 3, 4% go to women and venture capital, but how many are actually pitching? So basically, what's the funnel look like? I don't want to play down that question. We will talk about it tomorrow, fully and head on. And so what I want to do is thank this panel for kicking off that discussion. You guys agree too much together, but we'll talk about that later. Thank you, Craig.
Eric.
Thank you.
So we're going to talk about the future of work, but we're going to focus on metaverse. And we talked about it earlier this morning. Simon Vine is at the airport. It put this panel together, and then we're going to kick it off with Gary. You couldn't be here, but there's a little video from Gary Bowles, who leads the future of work at Singularity University. Go ahead.
Hi, I'm Gary Bowles. I'm the chair for the future of work with Singularity University and the author of the brand new book, The Next Rules of Work. If you're watching this, my flights didn't quite connect in Munich on the way to Athens, so I thought I'd pre-record some ideas. Now, I'll hand off the opportunity to define virtual reality, artificial reality, and extended reality to Dio, Angelina, and Simon, who are far more knowledgeable and experienced on the topic. But I did help to host a series of retreats 4 years ago, focused on the concept of an open metaverse. So I do have four fire starter ideas about the intersection of online worlds and work. Now, many of you will remember that in my book, The Next Rules of Work, I talk about mindset, skill set, and tool set. A lot of our talk about metaverses is about the tool set, but they can also be great tools for learning new skills and for encouraging new mindsets. So, fire starter number one. Silicon Valley is doing one of the things it does best, which is to settle on a single label for something that really is just a huge, broad category of software and hardware. There's no single metaverse, just like there's no single group of AI software. There are lots of virtual worlds, and they're mostly not interconnected. Calling video games, digital workplaces, and so on all one metaverse is a little overplayed. So if it's confusing, not only is it not your fault, it's meant to be confusing. So lots and lots of vendors can claim to be in the metaverse. Now, despite this confusion, there are some really good applications of the combination of virtual reality headsets or augmented reality devices like your phone and software that lets you do some interesting things. So Firestarter number two is things like workplace training for hard or complicated or expensive work can be much easier to learn with a good training application that's in a virtual environment. You can go down into a virtual mine shaft and repair a virtual robot or mix volatile chemicals in a virtual lab and nobody gets hurt. You can learn complex social interactions in social work or to perform conflict resolution with people who are fighting by learning in simulated situations. And as Mark Zuckerberg would like us to do, you can collaborate with and learn from people around the world using some immersive work and education environments. So, plenty of great applications today. Firestarter number three, the poster children for immersive metaverses are, of course, video games. So if you want to get up to speed, have your kid or somebody else's kid put a VR headset on you and show you how to play Fortnite or League of Legends, or use a screen and play Minecraft or Roblox, or use a smartphone and play Pokemon Go. That will at least get you conversant in what the experience is like. We put a VR headset on my 94-year-old mother, and to her it was transformative to go into a virtual environment as if she was in a national park that she could walk around in. Firestarter number four. Now, some of you may be familiar with the Gartner hype cycle. We entered into the trough of disappointment with metaverses years ago. Now we're in what I call a defibrillated hype cycle that's been kicked off again by the renaming and repositioning of just one company. There are many viable businesses and investments that are going to come out of these brave new worlds. Many of them will be in education and training. But when it comes specifically to the context of the world of work, most metaverses are going to continue to be sort of wild, wild west worlds. Relentless experimentation until the market finds more uses that can actually generate some return on investment for end users. And ideally, that will be because they've enabled people to solve problems individually and together in ways they could never have done before in the real world. So, strap on your seatbelts. It's going to be a virtual, bumpy ride.
Okay, so Simon Vine, if you could take over.
Thank you very much, Mark, and thank you for the invitation for my colleagues and me to this panel. The future of work is one of the most interesting areas, and we discussed many components of it. Today, we're discussing this particular angle, the influence of the metaverse on the future of work. And just to remind you, prior to the pandemic, we had about 30% of people working remotely. Now this number is close to 60, and all of them use something which soon will be called metaverse. And metaverse is a very important term for the investors because it is at least my feeling that whatever will be labeled as metaverse will get extra capitalization, some kind of kicker. What is metaverse? Metaverse is a new group of technologies which consists of at least 8 different technologies. And we're talking about something which is familiar to us as gaming. We're also talking about NVIDIA-like applications, which are actually hardware applications, networking, and many other things. And today, Nitin was talking about broadband as one of those facilitators of the whole metaverse. So it is very important that I think we understand how the concept works, because many investments will be going under the label of metaverse, and we'll have to understand which categories are actually productive and which categories are just trying to capitalize on the familiarity of the term. And with this, I'm leaving the podium to Angelina. Angelina will give us a little bit of methodology behind the whole space, the client, the market fit, and then product market fit, and then Simon will tell us how his startup addresses in the space, and hopefully you will see amazing applications which are available already. And then finally, Dear will give us a snapshot view on other things which will not be covered by previous speakers. And welcome to our first Metaverse panel.
Hello, am I up now? Yes, I'm going to share my screen with you. Can you see my slides? Okay. Hello, I'm Dr. Angelina Dayton. I'm an Aspen Institute Tech Policy Fellow, and I am the Senior Research Scientist at the Virtual World Society. I am an XR user experience designer and consultant, but I think I'm going to start using the term metaverse user experience designer and consultant. And I focus primarily on helping industry understand the large-scale deployment and mass adoption of emerging technologies. At Virtual World Society, I work with organizations, government, and industry to assess and predict the rise of the use of these emerging technologies. What I do is I gather the data so that people can make informed decisions about how to invest in what's going to happen next and reduce their risk. Jeremy Dalton is at PwC, and if any of you have been following some of the work that he's been doing, he predicts that the rise of VR, AR technologies will add $1.5 trillion by 2030 to GDP globally. I also am working with people that predict there will be 1 billion XR users, people in the metaverse, by the end of this decade. And what Jeremy says is everything is in place for these technologies to now deliver on the promise by improving the way organizations operate, make processes faster and more effective, and create incredible new experiences. I'm an anthropologist by training, and what I study is the average person and how to get mass adoption and large-scale deployment in Middle America, which is where revenue comes from. I believe that the average person will use XR technologies as seamlessly as they use Facebook. And in fact, Facebook believes that they will transition into the seamless use of XR technologies, and that's why Facebook is now called Meta. And I don't think they're wrong. You will witness in the next few years life, but different, life, but better. Change won't be dramatic. It'll be just like we transition to the smartphone. There'll be a day when we don't remember what it's like not to interact with volumetric, immersive technologies in the metaverse. There's a saying that people have that is, the future is already here, it's just not evenly distributed. And usually we're talking about how rural communities don't have broadband. But from my research, what I found is what we're really talking about is the uneven distribution of XR technologies between us and China. China is making informed decisions about how to coordinate vertically and horizontally across all their industries in order to make the most of immersive technologies and to lead the way, the conversation, and the technology, both hardware and software, in what's going to become the metaverse. They don't think this is a risk. They don't think they're investing in anything risky. What they already realize is that the only risk is not getting involved. So I'm here to provide any data, information, answer any questions about how that large-scale deployment and mass adoption is going to occur, and how to best make informed decisions about investments based on what we know happens when emerging tech evolves. My question to you is, what would you do differently if you knew the internet was going to happen 10 years before it did? Because those of us in the room right now that understand what the metaverse is and how it's already happening have that information and have already been through a technological revolution. So we're watching for the patterns, and we're giving information to people about predicting what's going to happen next. So if you'd like more information, you can contact me through Virtual World Society, but I'm going to pass it off to Simon now, who's going to speak to you about the future that's already here. Thank you.
Hello, everyone. I'm happy to be here with you, and I'll tell you about the metaverse through startups as we found it. So my name is Simon, and I'm co-founder and CCO at Collective Web, and we created a metaverse for enterprise. I just want to start it from where it comes from. A lot of people telling about the metaverse, but little of them knows what it really is. The term metaverse is used to describe the vision whereby the internet will evolve into a virtual world. The idea was first conceptualized in deep 1992 by the American novelist Neil Stephenson in his science fiction classic Snow Crash. It foresees the internet as the 3D virtual living space where individuals dip in and out, interacting with one another like in real life. So we create our metaverse for enterprises with video avatars for sales and communication. Internet will be changed in the next 10 years. The old web was static and consisted of text, pictures, and buttons. Despite today's high-quality images and videos, the web is still a two-dimensional, lonely place. And we believe that new web is a mix of digital and offline, and we are calling it phygital, with a vision of metaverse through an internet-enabled virtual world where people have avatars and interact with digital assets and even corporeal objects with augmented reality. With our cloud-based streaming solution, we've merged the best parts of three major technologies. Gaming, we created our platform on the same one as Warcraft or Fortnite game. Cloud-based and web, it means that you don't need to download any apps, and you can enter the metaverse via browser on any device. And spatial communication, it means that we create our own Zoom, and we have video and audio. And if we're comparing us with Zoom or Google Meet, here we have just one audio channel, and on our platform you have multi-channel audio. So we can be at one space, and one group of people can be one corner, other in another corner, and we will not hear each other, and we will reach each other, or we will hear it. So it's like in real life. And we started doing projects and pilots from the last year. Here, one of the use cases of the platform, we created for the top retailer in Europe a trade expo. Before the pandemic, they made it in offline, but COVID forced them to move all communication to online. And we created them at Expo, where each brand like Samsung, LG, Microsoft, they had their new product releases, and top sales managers were educated for 2 weeks in interactive gaming mode. So here we are using all gaming opportunities for business purposes. Users, they are moving with their avatars. On the left corner you see points, so client knows who is active, who is passive. On the map, they can migrate through the stands. here you can see quizzes and tests. So it's all gaming options here, you can see it. Another use case is virtual collaboration. And this is a standard template of the Office for the Snapchat. I'm sorry for jumping. It's on our platform. It's everything smoothly. Zoom is cutting slides and shots. So this is our standard templates of virtual offices. So people can collaborate and communicate. And if we compare once again with Zoom, for example, I'm speaking and all of you are listening to me. And on our platform, you can go to the meeting rooms, so you can, and no one will hear you. So everything like in a real office. This is another use case of the platform. We are calling it showrooms for the top brands. So what's the difference with today's web? We have an option for sales managers to communicate with the customers, and you can do that right now in today's web. This is another use case for e-commerce for one of the top brands in tennis. So here just standard SKUs products because of the NDA, but here you can see that you can move like in a real store, and you can also make a purchase here. So you can see it's the same template, but for another another client. It's US football team, and the value for them is that they can communicate with their customers. They can show their content here. So on the screen, they can download any videos. On the stores, customers can buy their merchandising, and in today's real world, when COVID is going, is a big value for them. And here, a custom
Simon,
project.
let's get closer to the end.
Closer to what? Sorry.
Let's finish it soon.
Sure. Yeah, I have just the last template. So we can recreate here anything we want, and imagination is just our restrictions. But we are going in a standard templates, and we are offering to our clients a self-service where they can do everything like in Constructor. And we believe that the future web will be 3D and interactive with the communication inside. Thank you.
Dio, please go ahead.
All right. Hi, everybody. Sharing here my screen. All right. Quickly, so because we don't have much time, this is who I am. And one point that I wanted to mention, just like elaborating a little bit on what Gary mentioned. So the metaverse is not really well defined right now. Every big company that you hear, that you see, they're coming from a different point of view from what they do. For example, this is Microsoft, where I was there. We delivered some products, some applications, and they're still, of course, they have done more releases. It's from the point of view of productivity and being together doing work. Like, as you can see, and you probably saw in the videos and examples, this is one of them, everybody looking at the HoloLens and seeing together, working together in a 3D model. There's another really interesting and very successful application, which is called Guides, and it allows people working in factories to be able to work on repairing equipment without having to bring the experts and fly them from around the world. Instead, they wear the HoloLens, and they have a 3D hologram that then the expert can move around and they can point, okay, you need to put the tool here, et cetera, et cetera. Facebook, as you know, they come from a social point of view mostly because that's what they're doing, right? That's their history, being a social platform so people can come together and enjoy together and play, etc. This is Unity Technologies. I used to work there, and they're the most popular, one of the most popular 3D game engines. In general, they're actually a 3D experiences creation tool. And what we were doing, we were focusing, again, because it's a creation company, it was about providing the tools and have people create together and being able to share those experiences. And then you have the crypto community today is also about metaverse. Metaverse is mostly, they're coming from the point of view of blockchain and specifically NFTs, being able to have, that certificate of authenticity when you create, your avatar, your items, etc. Because one thing that has been proven is that when the metaverse comes, one use case that everybody loves and is going to be successful is personalized avatars, personalized items, being able to buy furniture, etc. What NFT gives us is now that ability of, for example, buy the Gucci bag, that you are going to be able to show and say, okay, this is an authentic one. And then whoever downloads, copies an identical version, because today anything digital you can copy, you can download. But those are going to be the knockoffs. And so, one more minute, so we can leave time for questions, is also, in order to be successful for the metaverse, we need to also take a step back. And I'm not a pessimist. I love, the metaverse. I've been working on this since the early 2000s. But just like Gary mentioned, metaverse has come and gone several times. In the early 2000s, there was this wave. There were a couple of frameworks you probably heard about or not, because they're not really much around. One is Second Life, and the other is Open Simulator. Both of them, they were calling themselves metaverses. They were platforms you were able to create and buy land. They have the in-world currency. They have people, selling and buying furniture. You can buy your own house, etc. It was so popular in Second Life that Reuters created an office within Second Life, and they had a full-time reporter just simply covering events and news within Second Life. But what happened? Why didn't they stick? And so, I'll leave that perhaps for the discussion. It's a teaser there, something to think about. And this is just me. I'm a consultant in XR. That's all my contact information. Feel free to contact me. Thank you.
Angelina, Dia, and Simon, thank you very much. The quick summary is we are living at the time when we will have many new universes, virtual universes appearing. They grow very fast. When they become popular, we will have many more Facebooks and many more other types of companies which will appear in the next 3-4 years. And that's why it is definitely worth watching the space. And thank you very much, and thank you to our dear audience. And Mark.
Well, Simon, you're not getting out that easy. So, although the great thing about Simon is he was in Portugal, and in, 48 hours, he put this panel together. Imagine if he had a little more time and he was in New York. So, I think this is a great, and you spoke about it earlier today, so let's go. A lot of these subjects will be catalyzed into deeper dives. So before we go into tech, which is sort of a cousin area, and bring up that panel, any questions to the presenters? I'd like to know how to move myself around on the screen. That's one of my questions, but any questions about the fundamentals? One I had was, I've seen these, it's looking better, it's more compelling. I don't know why Second Life didn't take off, but I like to sort of get a sense of the numbers and where the investment opportunities are. So if maybe the panel could speak to that as a kickoff question. I guess I asked 3 questions in one, but any of those, any of the above. The numbers, why didn't Second Life take off? Whatever you want to talk about.
Did you want to answer why you think Second Life didn't take off?
Sure. In my opinion, there were several factors. One was the headsets, the lack of real immersion. At the end of the day, it was just like a game, a 3D game where just you walk around in your avatar with your mouse and keyboard. So you had to be on a PC to experience. So that part of the experience and the platform. The other factor is perhaps even the use cases. It came like, even though so many things happened there, there were conferences, there were, collaboration. I taught a class in Second Life. I attended mental health support groups. But it sort of stagnated in the sense that it didn't evolve more. It just became a little bit of more of the same. In Second Life particularly, it was not interoperable. They had their own currency, but that was it. They had a programming language where you can create, items and all, but it was very like a walled garden. So that's why it didn't become the real internet, right? Of worlds of worlds. Open Simulator is actually that. It allows you to have your own computer, install Open Simulator, and immediately connect. So you have your own metaverse and all. But as a open source product or framework, didn't have the money and finances and all.
And I would add, if I may,
Go
briefly, that what we see with immersive technologies is the ability to do things like telemedicine, to train in a technology that later on we can use for therapeutics. Second Life didn't offer that. And so when you have an immersive technology, there's more options available. Sorry. And so I think what you're going to see with immersive technologies is the ability to train more effectively and efficiently so you have a business case to invest. And then that's going to translate into real world uses, such as therapeutics or safer pipelines like they were talking about, where you can train with the HoloLens, and then you can reduce risk at the work site.
Questions? Any other questions on Meta? We got all figured out? Well, it gets better, and I think you make a good point. It needs to be not just a game; it needs to be like functional and interoperable. So this will be another ancillary way of something we should focus on. So thank you to the panelists, and to Simon and to Gary. I think you're live now. Thank you, Gary. We all watched the video between your flight from Munich to Athens, I think it was. So again, thank you to the panelists, and we're going to move on to tech. So thank you. So as I look at our tech panel, we have, is Aaron Hatton in? We have Anna Haskell. I see you're there. Really moving from the oil and gas world to tech and media, which is interesting. Eddie Vonderpart snuck off somewhere. He'll come up. I know Laura cannot make it. Vani, I don't know if you're online. Pulak.
I'm here.
Okay, awesome. Good to see you.
Hi, it's good to see everyone here. I'm glad to have an opportunity to be here right here.
Great.
So I just thought I would focus on just some new efficiencies that we're seeing in this space. So for example, what we're starting to see is a lot of new technology being built that continues to solve old problems. Now, this is something that I've seen spoken over and over over the course of the years. But what we're seeing is that there's an opportunity now that there hasn't been to create a lot more development more efficiently, at more efficient development costs. And so this is different. The cost to develop technology 3 years ago is much more expensive than what we're seeing today. And so I think it's worth looking, and I think we are looking heavily at a lot of early stage companies that are going back and saying, can we solve some of the older problems with some new technologies? And what I mean by that is, can we drive engagement? Can we drive user engagement to see if there can be improvements? I had the opportunity to invest in a company recently in the workforce space. It's a mentorship platform. This is a space that has been approached over and over and over again by corporations across the board. But if anybody has watched anything through the pandemic and the Great Resignation, workforce engagement has become one of the top priorities across every corporation. And software tools are definitely going to be part of that solution, but they need to be built in a way that drives engagement with the end user. And the solutions that we see that are utilized today by companies are not doing that. And so the companies that are being built right now, I believe, are lighter technically, and they're going to be able to start accumulating proprietary data on that engagement. Those are going to be the companies that I'm ultimately keeping a close eye on as the growth companies for the future. They're kind of subtle in how they're trying to approach those problems, but if they track that engagement properly, and we have the resources and the technology to do so today, that's going to propel those companies to actually create the proper products solving the problems more efficiently. But again, I want to focus on this cost to structure a startup. I apologize for that, because it's also come down with a lower development cost. You have no-code solutions across the table, and this is creating an environment where just about anybody can go and create an idea and create a solution at a far less cost than available. And what does this mean overall for the market? I also believe that we're going to start to see more efficient forms of funding in early stage technology companies. It's a highly illiquid, highly inefficient market. You cannot understand what may or may not be going on in those markets early on, or at least the traditional landscape is. But more and more, I'm starting to see these companies go to crowdfunding platforms, for instance. It's interesting, because before you may not have seen companies that may have had reviewed, audited financials. These guys are going out there and saying, I'm ready to prepare on and to raise on a public market. I believe that this and other fun work that I'm doing is going to continue to create that overall higher efficiency in early stage investing that can continue to create more and new value opportunities, not just across stages. We're talking pre-seed to seed. I think those barriers are going to continue to decline. I think the definition of what we even call it, I'm going to throw an anecdote in there because I heard somebody talking about it earlier. For the gender lens work I do, I often hear women who are generating revenue, women who are CEOs of a company generating, they often say, oh, we are pre-seed. And often, when I hear pre-seed, I think of a concept, I think of a spreadsheet, I think of an idea. If you're generating revenue, that's a pretty further along than what one might conceive. And so what I'm driving to say is that these greater efficiencies within the market, it's going to reduce those barriers across stage, but also across asset classes. I'm seeing a lot of opportunity to be looking in technology, but seeing how technology can be used with other growth classes, such as real estate.
Great, and I appreciate you just jumping right in there, but I have a place marker to Harjeet on that stages and blurring and how things are happening, so I don't know if you're on, Harjeet. But first, let's let you, and maybe Pulak, you could, because you're a little broader, you're both a technology platform and you're talking about asset classes, and then we'll turn to Anna. Here's some mics. 1, 2.
I'm sorry, I didn't hear that.
We're going to just pause on that, Bonnie. We'll come back to you in a moment. Just going to let the panel roll through here.
Okay.
So I'll take a quick minute to introduce myself and the space that we are in. So we are in the asset tech space, in which is very, very close to almost everybody here. And asset tech is one of the vertical silos in the fintech world itself. But we are taking a different view of it, and why we are taking, and what is it that asset tech will bring to this whole market. So just as a brief background, I've been in this business for the past 25 years. I was a founding team member at GSO Capital, which was one of the earliest credit funds spun out of Credit Suisse. Went on to become one of the biggest or largest credit funds. It's part of Blackstone now. So, and a thing that we realized, and it kind of propagates across the illiquid or private capital markets, was was that the private capital markets in one way differed very, very much from the public markets. And the big differential was the public markets had been designed to be or to move towards something like a straight-through processing. So everything used to works there. The private markets, there was nothing equivalent to that. So they were highly fractured. The data was all over the place. The systems were not there. The processes were not there. And we were constantly struggling to build any kind of scale as we were building our system while we were at GSO. And scale comes to anything. What is in the deal pipeline? Or what is our liquidity currently? Or where are the valuations? I mean, these are all questions that every manager who's in the public or private markets is asking, but they don't have a clear answer. And how do you manage all of these different questions? There were no good solutions. There are still no good solutions. And so one thing that we had discussed, and we worked on it quite a bit, was what is it that makes you efficient? And at that point, it came down to what everybody knows. We looked at the assembly line model, and we said assembly lines were designed by Ford, but they are still being used by Tesla or by the chip manufacturers or almost everybody. How can we design systems which look more like assembly lines, especially in the asset tech world? As data flows, can we think of it like an assembly line and build systems around that? And these are essentially going to be the platforms of the future. So private capital markets did not have anything like this, and that's what we have started building out, and we have put together many pieces of it. There's a ways to go, but that's what we are doing. And platforms are going to be the future in many ways.
And you're going to switch gears completely in a way. So, in fact, your career is sort of parallel pathing, switching careers. I'm so intrigued by what you're doing.
Hi, can you hear me? Yeah. I actually have some slides. I don't know if anybody kind of picked up my slides, but that's fine. I can go without them.
I'll try to wing it here. Go.
Sure. Well, so my background is actually hedge funds, and what I focused on most of my investing career was special situations, contrarian situations, value investing, and essentially picking up on niches where a few people are looking. So me and my hedge fund partner are doing exactly that. So we're not looking at it as a career switch. We're starting a company, a tech company, and the platform is in the audio space. So we're not talking about metaverse. We're not talking about Mr. Sugar Mountain announcing that we're going into video. We're actually looking into audio, which we think is a great niche, which we think is unexplored. Very few people have actually tried to create, a platform out of it and make something that, is revolutionary. So we think we have something. And what my slides were on actually what is happening in spoken word audio, and that is spoken word is anything that's non-music and non-video. So we're talking about radio, we're talking about podcasts, we're talking about things like streaming radio. And there are two trends that are happening there. The first trend is that people are listening to less music and more podcasts and more spoken word. So that's a huge trend happening in the past 7 years, huge shifts there. The second shift is that in the spoken audio universe, people are actually listening to less radio. They are shifting. The share of radio in the past 7 years has fallen from about 80% in spoken word to about 48%. That's a huge shift towards podcasting, towards audiobooks. That's not my slide, that's my pitch deck, but that's fine. Yeah, that's great. We see lots of problems that nobody has solved so far. To talk about the size of the market, podcasting market, is about $1 billion in ads, about $11 billion if you're looking into subscriptions, everything, the whole universe. And $100 billion if you're looking to spoken audio, which includes radio, right? So if podcasting is taking share away from radio, then we're looking at a potential market of $100 billion, which is already substantial. Then we're looking at $1 trillion market, which is video. And just to give you an idea, today people, daily listeners of podcasts, it's about half of the US population over 13, they spend 2 hours and 6 minutes on average listening to spoken word, which is found fascinating. So we think that that's gonna increase because they spend much more time looking at videos. So we think $1 trillion video market, spoken audio is gonna cut into that as well. So what we have, the problem that we're solving is we're an interview platform. We think we can scale this to a large percentage of the podcast. We are solving a problem of extracting person from audio. A person, we're indexing podcasts, we're indexing audio content by person. Nobody else is doing it at scale right now. We're doing it. We think not only we're going to be able to index, that's one part of the innovation, but we're also going to be attaching to a lot of the personal branding, revenue monetization opportunities to a person in spoken audio, in spoken word, that nobody else is doing right now. So the platform is called Podverb, and we have just launched a self-upload product where we let people upload their own interviews. We let people interview anybody. You can interview anybody in the room. You can do it in MP3 format. You don't have to do it as an RSS, real simple syndication. You can index it to your guest. And then you can personal brand yourself. You can do LinkedIn, you can do anything you want on all of the social media platforms. We have our own player. We have just closed our friends and family. My hedge fund partner and myself are funding this. We have just closed our friends and family. We have launched 2 partnerships, one with an NBA star and one with a Broadway production company. And we are less than 6 months old. We're looking, if anybody's interested, for indications for pre-Series A or post-seed or whatever you want to call it. So that's the opportunity in spoken word audio. Thank you.
And if you can introduce yourself, because you wear 2 hats. You're doing deals on behalf of your family office, and then you've hatched this baby, right?
Yeah, so I'm Aaron Hatton. I represent a single-family office based in Southern California. The family's created and invested in and I guess advised technology companies for the better half of the last century. And the principal right now is the principal is running a family office and also working on our new operating company. So when we thought about structuring the family office in 2016, he wanted to make it so everything, we would say one of our themes is like that technology is outpacing human adaptation to learning about it. So the way that we've developed the family office is open APIs, SDKs, everything is, I guess, digital. And that's what I'll talk about today. So this is one of his slides, and he probably does a much better job at presenting it than I do, so you got to bear with me, but okay. So how to thrive as a family office in exponential digital times. So our key themes are the fact that technology is outpacing its human adaptability. As you can see, the learning curve hasn't caught up to where the technology is today. So if you look at where we're at today, the year 2020, we believe that if we think about artificial intelligence and the fact that humans are usually poor substitutes for robots, that as of today, we can simulate one human mouse brain with every piece of artificial intelligence that we develop. So we'd rather use technology to do the mundane work and let human minds flourish and be creative and thoughtful, as to what they were built for. An example of this would be how Huang's law has outpaced Moore's law. So this is something that we talk a lot about. NVIDIA's actually just became the 7th largest company on the S&P 500. So some of our themes in the family office are the rise of decentralization, the great wealth transfer, obviously the rise of alternatives. We think that our advancements in AI and machine learning have brought us into the 4th industrial revolution. And then the 3 laws that we always keep in mind are Moore, Wang, and the Metcalfe law. You can see an example of here today what in 2004, the top 10 companies by market cap versus today, and how most of which are shifted to technology. And then this is just an example recently to reinforce the trend. It's got like 2 more. So Sky and Ray, we were founded in 2016 by Michael and Camille Sikorsky. Our expertise is in fintech, wealth tech, machine learning, mobile, and design. The family office was originally inspired by David Swensen in terms of our portfolio construction. And then kind of our thought process is, what does that mean? Heavy alternatives. We think that, so we're designed to be a digital family office. Artificial intelligence first, we're building everything with open APIs, and then written culture is important. So we're using technology to document everything from day one, so as we grow, kind of the themes and thesis won't be ignored. And then the new operating company is a business called Copy Wealth Studios, and it's a mobile platform that allows families to preserve, grow, and validate their wealth.
Okay, so from any questions from, you've heard of, tech media world, where I sort of completely messed up her presentation, but she overcame that.
Hey, Mark.
Yes.
I got a quick question for the book days.
Yep.
Thanks. From the last presentation and maybe from the GSO side of things, can you speak a little bit about greater cyber and heightened cyber protection to this? Because, if you're dealing with some of the ultra high net worth folks, there's an expectation for that barrier. What are you doing to deliver that on service?
So we use Amazon Web Services for each family. Sure, so we use AWS, so each family can be set up in the way that they want to be, but we, through our due diligence and the team's experience having decades in technology, we rely on Amazon Cloud right now. Each family would get like an encryption key, their attorney would get an encryption key that would be set up and go through like the protocol to get their data in, and then once they're into the system, we use biometrics to log them in, and then on the back end, no concierge or client service person sees their data unless allowed access to.
Cyber is actually one of the most important pieces of data that you're putting together, and this is across whether it's family offices or it's funds or asset managers. All of them are looking for very, very high level of security. So there are a couple of pieces to how we look at cyber and how we manage it. The first is external people trying to get into the system, and that's where, like he mentioned, it's an important part where either AWS or Azure or in their security and the way they have encrypted things and the way they allow you to allow access into the systems. They provide a number of levels of security, and it's up to the developers and the intelligence of the developers to take advantage of some of those cybersecurity services that are provided by both AWS and Amazon. But then the second and important part also is, what if somebody is trying to somebody internal is trying to get into the system, or somebody internal is trying to download data which he's not supposed to have access to. So again, you design systems where access is very well controlled, and you can monitor who is doing what at any point of time. And our systems have been created in such a way that if somebody, for example, just is trying to download the entire investor list of at an asset manager, this will be immediately stopped. And so you have to design your systems internally also to be able to take advantage of some of these some of the features. The other part of it is internally also. I mean, the biggest hacks that come is because of somebody has lost their password, or the password is easily traceable. So there, I mean, multi-factor authentication has become a big deal. It's a very, very critical piece that goes into it. But then IP tracking. There are so many features that are being that can be incorporated into the design, that you can really stop malicious folks getting into it. And finally, sorry.
You said finally, so I'll give you the final.
Yeah.
Go.
Yeah, and then finally, there's one last thing which people don't realize quite a bit, is data which is in transit between AWS and in your system. And again, you should have your HTTPS encryptions and all of that in place. So all of those things you have to put together to put a proper security protocol.
So two things. And you're going to stay around for the consumer panel. So that's where we're going to make up everything. I'm going to find your deck too. But Hamlet, as a cybersecurity fund investor, he invests in funds and directs. So I just said, step in. If you could grab a stool. The question is, I think from Rob, is, okay, it's great to optimize your data, but what about the cybersecurity aspects, broadly speaking? So you heard their perspectives. What are your perspectives?
Thanks. Real quick, Hamlet Yusuf. I run a venture fund. We focus on national security, defense-related technologies. So cybersecurity is a big area of what we invest in. The importance of cybersecurity, this probably talks a lot of stuff you all talked about earlier, is traditionally, when you looked at hacks and compromises, the hackers, whether they're hacking syndicates or if they're state-backed entities, they're going after Microsoft, they're going after CIA, they're going after the State Department, they're going after big corporations. What's changed over the last several years are starting to go after what we call soft targets. Targets that don't have the resources, the infrastructure, and the layered approach to protect their equities. So what's happening is, if you have a group of Russian hackers or Chinese, North Korean, or Iranian hackers, their day job is to attack national security interests in the US, the UK, the West, or elsewhere. They're using state-developed tools to unofficially target valuable assets. At night, they can do whatever the hell they want. So the Russian government will look the other way, or their overlords will look the other way, and they can use that same infrastructure to go after an easier target. Well, what's an easier target? Family offices, law firms, accounting shops, small and mid-sized enterprises. Those are becoming more and more high-value targets because they don't have the infrastructure, they don't have the best practices, they don't have the best training in place, they become an easy target. So me as a hacker, my job is to steal national security secrets. I can make up my side hustle by hacking an enterprise or entity or family office and getting away with whatever I can get away with, and I know my overlords aren't going to do anything about it. So having the right layered security, I think, is critical. This is something you don't learn by going through a couple of seminars. I think you best bet is to understand what that right what that right tech stack looks like, and make sure you have that to protect your interests. So.
Can I answer that question too, real briefly?
Sure.
Yeah, so in response to Russian hackers, we have a team of Russian PhDs, and we're doing everything on our server. So we're trying to create an in-house solution, but for more commodity type and data-heavy things, we're going to use AWS as well. For example, for speech-to-text, we'll use AWS, which is expensive but necessary.
Any questions about the sort of technology, the companies that they're working on before we switch to consumer? Yeah, Greg?
So I have a question on the audio project. You mentioned music is now second to spoken word in terms of people's interest. Do you have a categorization of what spoken word people are flocking to in terms of what are the topics of interest?
Yeah, I actually do. There was an NPR research that just came out, NPR Radio and Edison Research, and I can remember from memory. So about 60% of people are interested in engagement and connection, so anything that has to do with mental health, like connecting with other people, which is the, I guess, the pandemic, the side effect of the pandemic. About the same, 60%, yeah, here you go. Self-improvement, 60% of podcast listeners. Encouragement and positivity, 57%. Education, 46%. And unique perspectives, so 60%. So this is what I've just mentioned is among younger listeners. The general population is interested, like in the majority, like these primarily have to do with like younger, less than, let's say 45 listeners, and the general population has a variety of different, crime. True crime is a big thing. Interviews. Now, we are an interview platform. We think a lot of the sectors are covered by interview format, up to 75%. We are not necessarily two people, but we want at least a question and answer, so maybe two co-hosts, one guest plus 1 to 3 to 5 guests. That's 75% of the market. People love interviews. That's why it ties very well with unique perspectives, especially the 60%. Yeah, that's a great question. So Clubhouse actually has been part of the reason that spoken word audio is gaining market share. The overlap is that Clubhouse right now, the way they are now, they're so-called ephemeral content, right? The content is presented in group chats and then it disappears. However, Clubhouse has just announced at the Wall Street Journal conference that they are moving into recording what was said. So the feature is replays. They're doing a podcast feature as well. But we don't think that we're competing with them. We think we are very unique because we attach a person to audio, and they're doing it in a slightly different way. Not everything is going to be replayed and put into real simple syndication. There's a lot of copycats right now to Clubhouse as well. Including Facebook is coming up with something, Twitter is coming up with something. So it's a different format. It's nice, it has its challenges, but it's different from us.
Just what the world needs, another social network. Well, look, thank you very much. You can stick around because we're going to talk about consumer. And we'll transition. We're going to pick up all these on the breakouts shortly, including cyber, tech, and the rest. So if I'm on the consumer side, if I could ask Julia to come up. Ari, who's developing an interesting product relating to water testing. Julia in the healthcare space. And I think there's some people on Zoom. I'll pick you up momentarily, but let's just start with the people that are here. Ari, since you're closest to me, introduce yourself and what you're doing to help the world, the consumer world.
Mike, sure. Hi, my name is Ari Kaufman. I've got a 25-year background in digital media marketing. So I always joke that I'm the guy that used data to track you online and get you to buy stuff without you knowing about it. I was very good at it. I've had a number of exits. First two companies went public. And then somewhere along the way, I developed a conscience and decided to do something that actually mattered. And 4 years ago, I got the water bug and decided to see if I could do something about what happened in Flint and make sure that didn't keep happening across our country. And developed a product that detects lead in drinking water in the home that a consumer can use without beakers and pipettes and chemistry sets. And you can basically use it to test your water in real time. It tells you how much lead is in your water quantitatively. It sends data to the cloud. It tells you all the test results that are happening in your community in real time. It tells the water company how much lead's in your water. It will introduce you to products and services that you can buy to solve the problem in the meantime. As a result of the new infrastructure bill that's just been passed, it's going to help identify the location of all the lead service lines across the country. We're working with over a dozen different water utilities already to get these distributed to low-income families, so we can use this to start finding the lead service lines. Middle-class families will be promoting to using that digital media background, targeting consumers online to get them to buy it. And there's about 75 million homes across the country that need to be measured, of which we expect about 10 million will have a lead service line. So that's my background. We've been working on this for 4 years and plan to be in market in about the next 7 months.
My name is Julia Monfenipi.
All right, maybe over here.
Thank you. Hi, my name is Julia Monfenipi. Great to see you all here. I am the founder of Pace Healthcare Capital. We are an early stage investment firm backing entrepreneurs in digital health and healthcare technologies. We are based in Chicago, as Mark knows, as my accent would not tell.
You had a Chicago accent there.
I am based in Illinois. My personal background, I have spent 12 of the last 16 years investing in healthcare. The bulk of my career is in private equity, where I have invested over $1 billion of capital in transactions big and small. I was co-head for healthcare services at CDPQ, a Canadian pension plan, where I was in charge of our pipeline and portfolio in healthcare, direct PE for North American and LATAM for a few years. And from there, it was pretty obvious that there were many underserved areas in terms of capital in healthcare where the traditional Silicon Valley funds were not looking, because we were really deeply entrenched in the healthcare system, and it's pretty complex to navigate. And the best companies were not necessarily getting funding just because of pattern recognition from where the traditional tech VCs were coming from. So started Pace, and along the way found many other underserved areas in terms of capital, one of which is women's health. And women's health is actually, at this stage, mostly a consumer-driven market. So meaning women are going to pay for their own health as opposed to insurances stepping up and the overall life science industry looking at funding trials and so on. So we've backed women-led companies addressing needs in women's health as well. And it's a consumer-facing investment strategy because you do need to find people that can talk and relate and understand what women needs, and it's a healthcare tech play on the back end. And so I can walk you through examples of, as I've talked at our last circle, by the time I'm done telling you about menopause, you all wish you had it to join our club and our telemedicine platform that's led by former editor-in-chief of Marie Claire, Anne Fullenwinder, Monica Molenar, who is a serial entrepreneur that actually I found out is a personal friend of Eddie, sitting here. And she's pretty open about it, a hysterectomy at the age of 40 that sent her overnight into menopause and didn't feel like just going through the hot flashes the way our mothers went through. The third co-founder is Dr. Sharon Malone, Chief Medical Officer and OBGYN, who led a podcast with former First Lady Michelle Obama about a year ago. Yeah, we have more to talk about.
So just before we go to Mohsen, we met in Cincinnati, and I think Eddie invested in you, and he might be investing in you, so serendipity there.
Or just Mark, great work.
So Catherine Hill Ritchie, are you able to join us here? Are you there, Catherine?
I'm here.
There you are. Well, what excites or scares you about the consumer product services world?
Sure. So a lot of things, actually. So, Nottingham Spurk is a big investor and creator of the consumer product space. There are probably 10 or 15 devices in your kitchen, bathroom, or garage that we actually helped create or invent. I think what's interesting today, what is exciting, is the rapid prototyping and development that we're able to do. As you all know, you need to iterate a lot when making products, and we're a strong believer in the soft launch. And the reason why is because inevitably there are always mistakes that happen. So it's always nicer to take your product out through a soft launch and then work the kinks out. So that is a positive part. But what scares me is, when products are released too early. And one of the things that concerns me, I live near Washington, D.C. now, is just the list of chemicals that we're able to use and still are getting in our consumer products. So I think there's a lot, there's lobbying to continue to be done, and has been done on all the chemicals that go into the products that we use every single day and the packaging. So that's one thing that we're working on too, is looking at sustainable packaging, looking at products, especially we've done a lot in oral care, dental care. So, like we invented the spin brush toothbrush and sold that to Crest for $475 million. We're working on a new dental oral care product today, and we wanted to make sure that, again, nothing in the packaging could be bad for you. That's things in your teeth and your gums are really absorbable, but you wouldn't believe some of the chemicals that are still allowed because in so many parts per trillion, it's deemed to be okay. But the problem is if you're using 100 products that have parts of these chemicals in there, then they really do start to add up. So those are some of the things that scare me. But there are also just amazing innovations happening in the consumer product space, and also even in the business model, the D2C. Instead of, as we saw with COVID, some people weren't shopping as much, but they were shopping at home. And so those business models enabling people and consumers to get products quickly at home has been fantastic for the consumer products world as well.
So Catherine,
but I could go on and on, happy to answer any questions.
No, we really, truly enjoyed that tour of your facility. it's not Silicon Valley innovation, it's like Midwest innovation. Let's get it done and smart. That was very inspiring.
We invite you all back.
We'll be there. So actually, what you said, like there's a Russian expression, choot-choot. So if you have a lot of choot-choots of vodka, you get drunk. And it's similar. We've seen this, you're going to hear about on the industrial side. We really need, and the great thing is they're great investments that can solve these problems. And that's what we like to showcase. So there are a couple people, probably should have been on the tech panel, but everybody's a fintech company. But why don't you just share your story real quick, and then we have another great success story that just came up.
Sure. Thank you, Mark. So my name is Mohsen Masood. I'm the founder and CEO for Accrue. We're lucky to have a lot of support from this group, especially Eddie right here is one of the investors on our cap table as well. Really appreciate the support on that. What Accrue does is we fractionalize commercial real estate. We take a $100 million building, break it down into $1,000 shares, and let everyone not just invest in that building, but we've also created a secondary market where people can buy, sell, and trade those shares as well. So truly adding liquidity to an illiquid market and opening it up and democratizing it so that everyone is able to have an equal opportunity, and no matter what your income level be, you should be able to invest into this asset class and build your wealth over a period of time. Having said that, we are limited to accredited investors only at this point, but there's a large chunk even within them that need a lot of democratization. So accredited investors being anyone with a net worth of over $1 million without your primary residence, but then also if your household income is over $300,000. So most of middle America, most of people working at P&G, GEs, and the corporations of the world are able to qualify for that. So we want to make sure everyone is able to invest and can take benefit of commercial real estate investing and building their wealth on. But yeah,
only someone from Cincinnati, like middle America, people who work at P&G. I understand. Here's another great success story that just sort of is happening in the sort of fintech to consumerish world. Mike Carr.
Great. Hi. Hello, everyone. My name is Michael Carr. I'm the CEO of Amgen. And what Amgen is we're a digital process automation company that helps travel management companies, companies like American Express, BCD, Carlson Wagonly, be better with less people. So because of the pandemic, obviously, and travel is starting to come back, especially domestic travel, there's less people out there that can actually be hired to do the work of what travel agents actually used to do. So in the past, corporate travel was a $1.4 trillion a year business. About 400 billion of that was going through travel agencies, and that means a lot of people have to do that work. And so what we do is we actually read the emails or text that comes in from the travelers, and we process itinerary recommendations all within seconds to a few minutes using AI, our patented AI platform. So we're working with 8 TMCs right now, mostly US. We're based in Toronto. We actually are raising money at the moment, looking to do so.
We don't pitch exactly. So. but the great thing is we made one introduction just to see if someone in our network really understood the space, who understands the space if they saw value in their business model, and it looks like we got a bullseye, which is a great success story.
Yeah, and we find that going forward with this platform, there's, as I said, there's hundreds of millions of transactions that are out there that we can process annually, and we've got a technology to do that.
Great. Thanks, man. So all that said, any questions of these business models or other questions as it relates to the consumer sector opportunities, what scares and excites us? No, this is crickets here. Come on. Gary, you have a question? You had your hand up. I love it. So consumer-oriented questions, media, technology, healthcare, wishing we all had menopause, fractional ownership of real estate, solving the water issues, testing and mitigation. Comments, okay. Yes.
So, having the privilege of working with Mike and Greg and Mark Sainor,
I'm John Pagley, by the way. I said to Greg in our conversation a couple of weeks ago that you really are an impact investment in that you are contributing to solving the supply chain problem, in a very unique way. So that's what I had to say. So if you want to expound on that, thank you.
Well, thank you. Yeah, you're absolutely right. I think that what we have seen because of COVID, a lot of the travel agents aren't coming back, frankly speaking, and they need to be able to do more with less. And the problem with travel is it's a laggard industry. It's an industry that, frankly, still looks at the same types of screens you'd see 30 years ago. If you're familiar with Sabre, for example, they haven't really moved on from that. So we have basically been able to build a platform that disrupts that, a platform that lets them do more with less, as I said, and really sets them up to be competitive with some of the new companies that are starting in this industry. So for example, if some of you have heard of TripActions, TripActions is a new platform for business travel. It's innovative, but companies like American Express and BCD need competitive platforms. And that's what we do, is we actually make them competitive. We give them the technology to let them be competitive in this industry, and we're really proud of that. So thank you. I think that, yeah, absolutely, we're being disruptive.
Hi, because you're all in consumer space and about data governance, so what are you doing on that level, and are you using any external bodies, or are you looking to apply for B Corp status or something like that? Because obviously no one likes their data to be shared, and if it's what we know from corporations being there many years, that data is misused big time. So what are you doing as new brands on the market to protect consumers? Thank you.
There we go. So having come from digital media marketing space for a long time, personal private information is something I know a fair amount about, and consumers definitely are super sensitive to it. And now the largest generation coming through the market is millennials and Gen Z. And it's funny because being Gen X, we're the forgotten generation, and anybody always says to me, my God, you have this incredible amount of data. How are you charging for it? What are you monetizing it? And I say, we don't. Healthcare information is public information, right? So all this information that we're getting about people's homes is democratized and given away for free. Anybody can access it. It has to be democratized, right? It has to be available to the media. It has to be available to academics. It has to be available to governments. It has to be available to everybody in order to solve a problem. And so that is the way that you handle it. You don't monetize it. You make it available to everyone. No, I don't, say, here's John Smith's 123 Main Street, and that's their data. We say, here's a quarter mile, or here's a square block, and here are all the results for a square block, so that if you want to dig in, then the water company can come and dig in, or consumers can dig in. I did want to share an observation now. I raised a lot of money throughout my career, and had multiple exits, and done better than worse, and they certainly have crashed and burned a company before too. One of the observations that I've had in the impact space, and this is certainly my first time that I'm in the impact space, is how risk adverse investors really are. So much more risk adverse than tech, so much more risk adverse than hardware or software or fintech or healthcare. It's amazing to me how much impact investors talk about the need for innovation, and talk about the need for change, and talk about the need for acceleration, and then talk about the need for revenue, and talk about the need for traction, and talk about the need for, I'm pre-revenue, right? I have a prototype, I've got data, I've got a product, but I'm not in market yet. I have a list 150 names long who say, come back when you have revenue. Great, I got no problem doing my next round. But when you talk about trying to get people who say to me, oh yeah, I will put money in before your product has gone to market. I'm not allowed to pitch, but it's amazing to me how easy it was to fund a digital media marketing company that had no revenue whatsoever. None.
But did you were you approaching family offices or funds?
Both. Family offices want to see somebody else do the valuation, want to see somebody else, put the money in first, right, do the hard work, and then they'll say, okay, yeah, I'll come in, great. But the funds that would normally come in first, the institutional investors, absolutely do not want to take risk in impact. And it's unbelievable, whether you have an impact fund or you have a traditional fund that now wants to have impact investments. It's frightening. And like I said, I've been raising money for years, so my list of contacts of people I can pitch is a mile long. And you cannot find the people that are willing to stick their toe in the ground, in the water. Yeah?
Yes, Cedric, go.
Additional commentary on having the background of raising capital. How are you getting around that kind of chicken and the egg with the revenue and the impact space?
That's a wonderful question. That's why I'm still raising capital. I actually did finally get a lead, but it's a very small lead. But they're pundits in the space, right? So it's really, really big names. It took a long time to get somebody who says, this is amazing. I can't write you a big check. But now a family fund or somebody will say, okay, well, at least you've got expertise. And that was what I realized, is I don't need to go get half my round. I can get a $500,000 check, but if it's incredible name of expertise, then somebody can say, okay, that's more important than the dollar figure. It was amazing how long it took me to figure that out, but that's what I finally figured out on how to do it, just to break into impact.
Yep. I've got a quick question on the consumer side for our friend from Canada. It relates to Peloton and sort of the dynamics that Peloton's experiencing, which is a little bit of stock reduction because they didn't play sort of the return strategy as clearly. But I put it to you in Canada because it seems like you would have some sort of arbitrage opinion, because I think the border's still pretty tight, and I think more Canadians are still staying at home and having the distance. But how would you advise like a Peloton to which is the bike equipment and the indoor exercise equipment on a strategy here?
It's a great question. I am actually based in Chicago.
Chicago?
Which Mark may correct me, but I think it's on the south side of the border. On Peloton, so Peloton is actually considered a healthcare tech investment, which for me as a healthcare tech investor still somewhat shocks me. It's a consumer-driven business. They need to want you to buy their equipment and join their classes. They don't measure actually how much your body feels, your wellness feels, how often you're really there. They don't track outcomes, which is the number one thing we look at for an investment when we go into healthcare tech. Is this something that will actually put an inflection point on patient outcomes or decreasing cost of care or expanding access, which is still something important in the US, as not everybody gets access to care. But it's not what Peloton is looking at. I can't really talk about the stock. I follow it as well, but it's not something I have a professional opinion about. I'd say they've barely scratched the surface of what they can do. There's a lot of space of improvement to gain market share, even still in the US, whether it's in terms of volume or services they can place at home, or now actually what they started slowly exploring, but it's closing that loop and going back as to what is it you really do with their platform, how is it improving your health, right? And as we shift towards them being a digital health platform or tech platform, how are they closing that loop, which is not done right now? But to me, it's a stock to track in the long term.
Could I just add, there's two people, you mentioned Peloton. So Peloton just announced a $450 million investment in, not Chicago, but Ohio. And what attracts them is we have a special tool in the toolkit that Joe, just 30 seconds of what Ohio did for Peloton and what it can do for others here.
Yeah, no, absolutely. Ohio is very unique. Ohio is the only state in the country that has privatized our economic development arm. That is funded by liquor sales in the state of Ohio. We're looking for, once Ohio goes recreational, to use recreational to fund that as well. Cannabis. So through that, it's very unique, the process we do have in Ohio. And with that, you're seeing not just HQs, but namely companies from the coast locating their second offices to Ohio. And Peloton is an example of one of the large companies that wanted to locate there due to talent and what they're getting from Jobs Ohio in the state of Ohio.
It's about $200-300 million that can invest every year direct into companies or funds. You said you weren't getting funded, or we're not putting funding into impact, and I wanted to introduce Rich Nespola because he's funding impact investments from a couple angles, including credit.
Yeah, so just a commentary, you know, our family's kind of incubated a bunch of strategies and kind of done a bunch of investments, but the other thing is just looking at the pools of capital that you're going after, right? So it's not the old white-haired folks that are going to buy into the strategy. It's G2, G3, G4 families that have a greater orientation towards sustainability and impact and kind of equitable treatment of others that you're going to have greater resonance with one. So, I mean, I'd encourage you to look at groups like Nexus, groups like And Impact, Align Impact, et cetera. There's a whole consortium of folks that kind of are tailored to that kind of orientation for investment, one. And then two, I'd say foundations can make PRIs, right? Program-related investments, which are tax advantaged in a bunch of different ways. And that's kind of opened the aperture here. It's been around for a long time, but for what you're doing, right, and for what others are doing on the impact space, it's just a much better way to take advantage of foundation funds that can make investments, quote unquote, below market rates of return or equivalent, right, for something that has meaning and aligns with their strategy, right? So it's typically an area that's underrepresented in terms of where people are going for pools of capital for support. It's also probably a little bit easier to navigate because you can go to a place like Foundation Source and a whole bunch of other places that list everyone's kind of returns, if you will, that kind of segment by size and what they invest in, quote unquote, or support to create that alignment filter for yourself, right? So it's all just kind of self-directed. Last point for you is I've been the kind of the chairperson of an organization called Earth Echo International, which was founded by Philippe Cousteau and his family, and all we do is water sustainability. So happy to talk to you about trying to get your product in their hands.
I'm going to chase you out the door.
Well, don't chase me out the door. I'm right here. So. Yeah, so for what we've been doing, we kind of realized that there was a gap in kind of private credit and financing impactful consumer brands in the natural and organic food, beverage, beauty, and pet market. We really kind of love it from a standpoint that it's a non-correlated asset class, but we really felt that for these great entrepreneurs and pockets of capital that were supporting this initiative towards health and wellness, they were getting absolutely killed on the cap table, not getting a fair share of their return because it's a capital-intensive industry. So they have to go back to the equity well every single time to fund their growth and trade spend and promotion and R&D, and then have nothing to show for it in the end, right? So for every RX bar that you read about getting acquired, or every kind of buy that gets sold to Dr. Pepper Snapple, there are hundreds of other companies that are out there that are in need of capital but are getting absolutely crushed, right? So from that standpoint, we kind of spend time kind of optimizing that capital structure for them. Also, too, investors get stuck in the equity forever because not all these companies exit, right? So we create a financing mechanism that kind of aligns interests across founders and investors and those that want an impact. So that's what we've been doing for our family now for the past couple of years.
You know, Mark, I was going to say, when we were talking about Peloton a minute ago, that the core part of their model is obviously managing for churn, right? So utilization, maintenance of utilization, frequency of utilization, fallout, making sure that the bike doesn't turn into a clothing rack. And when Joe mentioned that Ohio, and he said cannabis, and then he said, I thought maybe they had figured out how to keep people on the bikes.
Right. He's jumped the gun there a little bit. So let's do this. Thank you to the consumer panel. We're going to move on to industrials energy. It's our last panel before we break into two sets of breakouts, and then we break open the wine. So there's one person who can't make it. He's trapped in Brazil, but we have John Capolino from Tigris. Dan is around. There you are. And then more from a clean tech angle, Eddie. And have to say, Eddie also has invested in Rich's deals. So Eddie's ubiquitous. And he thinks he's a good ping pong player, but we'll find out. Yeah. Oh, look, Rob's already, get the smile. Rob beat me 11-9, or is it 11-10? I can't remember. 11-9. And my position is 11-point games don't count, but we'll find out. Okay. So why don't we start? We were talking about consumer products. I don't know if you heard Catherine Hill Ritchie, and they're like a little bits of chemicals that add up. And in the industrial scale, you're really solving for this. So why don't you introduce yourself, and then we'll pass it on down.
Good afternoon, everyone. That work?
Good afternoon.
Oh, that's work. You work?
Good afternoon. Wow, that's really strong. Lower a little. My name is John Capolino. I'm a co-founder of Tigris, a specialty chemical company out of Michigan. Our focus is on sustainability. We're an impact investment opportunity. Our mission is really simple. We're a solution-oriented business model, and our mission with really only two products we manufacture. We manufacture a safer acid, which is a very low pH, and a safer alkaliner base, which is a very high pH. And then we license that technology to leading brands and companies in different categories to help them make their products more sustainable. So every day we're looking for companies. I'll give you an example. We did a license with a company called ZEP. That's a big provider of disinfectants and cleaning products at Home Depot. And now Home Depot wants more sustainable products. So now our job is to help them reformulate their products so that they can provide consumers a safer, better alternative to the typical hazardous chemicals. And when you talk about being excited, we're excited because the product has impact across a lot of vertical markets. So it has impact in cleaning, in food tech, where we can make products last longer, fruits and vegetables by washing them. In agriculture, when we add it to crops, increases crop yield. In cosmetics, we can eliminate the need for preservatives by treating the water. And in biotech, we're working on a therapeutic where you can actually inhale this low pH through a nebulizer to treat COVID and other respiratory ailments. So we're excited. We have a brand new plant. We have a bunch of patents that have been issued, a bunch more that will be filed, and we're happy to be here today.
Hey, that is loud. How's it going? My name's Dan Winters. I'm the Director of Portfolio Development at Gardner Standard. A little bit about us. We are a family office investment firm that focuses a lot in industrials and energy, but really across the board as well. What differentiates our kind of business plan is that we kind of focus in the lower middle market space, but also into really complex and distressed situations. And we kind of like to get into our hands into it and really become an operating partner and apply turnaround management, become one with the company, and ultimately, you know, we're in for a long term. We don't have term or durations onto our investments. So, you know, a lot of our portfolio companies actually have been now sectored and have been within the A&D sector, within industrials, within manufacturing, and we can go on to the problems we're seeing in the trends we're seeing in the industry. But you know, I'll let everyone introduce themselves first. So.
Hey guys, my name is Eddie Vanderpart, and I'm running an impact venture fund, Virtue Capital Partners. We focus on a number of impact sectors, and for the industrials, probably the two that are most relevant are clean tech, clean energy, transition energy, and ag tech. And within that, we look typically for actually light asset models, but there's exceptions to the rule. And sometimes we invest in the sort of heavy asset models, more closely aligned in industrials. We look for stages, late seed stages through Series B, and for tech-enabled, heavy tech-enabled companies where tech can be, increasing returns to scale type of play. And an example that was already used here, but that comes through the 361 network, was where we invested in Acero, which is a gas to liquid company that transforms flare gas and renewable natural gas into oil that you can use in cars at a 50% reduction in emissions for half the price that a gallon of oil costs. And that's an integrated strategy that plays out right now, and currently raising $400 million for that strategy. And much more is needed, billions of dollars are needed, but that has the potential to contribute 5% of the Biden Green Plan. So that's a very significant impact asset, so to speak. I'll leave it at that for now.
The first plant does about, what, 1.5 points? Yeah, so that's rather impactful.
And they need about $6 billion for that, so it's not a done deal, but it's a big lift. But as you can imagine, a lot of people ask me the question, hey, why did you invest in an oil? Because that's a terrible thing to do. But people forget that over the next 20 years, we have more than 100 million cars still on the road. And those cars won't vanish from one point to another. The global EV market share is about 1%, and only in Norway it's upwards of 50% of the new cars sold. So that will go steadily and slowly up, hopefully, for us. But that still means that there's a ton of cars that need servicing. And so for the next 20 years, you'll still have your sort of cleaner plant for that.
Great. So maybe back to you, John. How do you see, what's a home run for how you can help the world with your products?
So when we look at each vertical market, we're all about being mission driven, and obviously in biotech, if you can save lives, there's no greater feeling than that. And so our biotech company has the ability, through dealing with different respiratory ailments, to actually save lives. In our agricultural side, by going even to third world countries and being able to provide more crops, because we increase crop yield anywhere from 10 to 20%. We just tested about 15,000 acres in the Midwest on soybeans and saw a 13% crop increase by adding our product to the crops. In food, this is a great story. We're working with a potato company called Eagle Eye out of Idaho. They're about $1 billion company shipping produce all over the U.S. And they were being asked for a fresh cut potato to sell as a fresh cut French fry, but they can only get the shelf life to about 15 to 20 days. We were able to get the shelf life to 40 days. So now they got a contract with US Foods, which is the second largest food distribution company in the country, and they're going to private label it in all 63 warehouses. Now what's interesting about that is, number one, you lower your trucking cost because you go from frozen to refrigerated. Two, you lowered your storage cost all through the supply chain. Three, they taste better if you ever had fresh French fries, like at Five Guys. But four, most importantly, you're lowering the carbon footprint because now you're using less energy. So when you can have that many positive impacts, that's a great way to wake up in the morning. And then on the cosmetic side, there's a trend called clean beauty that everyone's focused on, where you really want to look at the label and see what you're putting on your body and on your skin. And we now know, we've proven that we can eliminate the need for preservatives by treating the water with our low pH product. And we're working with some big companies on that right now. So, sometimes you have to start with a little inch, right? And then you start momentum, and before you know it, it becomes, I guess, a movement where people are really looking to make a difference. And that's why our company was formed.
Great. Dan, what are you excited about or scared about as you allocate in the industrial energy sector?
Yeah, I don't know how much I can add about us saving lives and helping out our agricultural space. But what I can say is, I think what we're seeing
You can invest in John's company.
Yeah, it could be.
You help me turn it around.
Yeah, so I guess what scares me, really intrigues me is, and you see this across the economy, because really, American economy is a large part of it are industrials and manufacturing and energy. Are you seeing the labor shortages? 4 million Americans just quit their job last month. and we're seeing the supply chain still having large ripple effects, and we can get deeper and deeper, but what scares me is, how this is a continuing trend, and, solutions are coming here and there, and we now have an infrastructure bill that may help and inject funds into the solution, but, long-term wise, I'm concerned where we see things going. So I think ultimately, I have faith, I'm optimistic, but those are the two major points that I'm always thinking about.
So I have somewhat of a supply chain background, and the biggest concern, I think, around the globe right now is the supply chain. But I don't think we should be surprised, because when you have an economy humming at 100 miles an hour, and then one day you wake up and you just turn off the light switch, the supply chain isn't like a light bulb. You can't go back 6 months later and just turn the light switch back on. Because what happens is everyone leaves their job, and now they're sitting at home, a lot of people getting paid, and now they sit back and they go, I didn't like being a truck driver away from my family for 6 months a year, or I didn't like working in a restaurant till 2 in the morning, or I didn't like not having my weekends. So everyone is looking at their alternatives, and in the meantime, while they're looking at their alternatives, they have a little bit of a cushion for a while. So now trying to turn that supply chain back on, it's a human supply chain. And everybody has their own goals, their own wishes, their own quality of life issues that they have to address. There's family issues. And the other thing about COVID is we all know that it was as bad as it could get, right? Who thought we'd ever have to go through something like that? But there was also gifts in there. You got to spend time with your family that you may have not had. My 18-year-old and 20-year-old learned about drinking wine. They studied wine when we would have dinner. And we got to have dinners that we would have never had. So in some ways, it brought families closer together, maybe making people realize, is that the right job for me today? And maybe I want to look at alternatives. And I think that's one of the things that's out there on the supply chain side. It's not going to change. It's not going to get fixed in a day, because it's a bigger symptom of the problem. So something to think about. You can throw a lot of money at it, but if people don't want to go back to work, or they don't want to go back to the job they were doing, we'll see how it plays.
Well said.
So Mark asked me, he stepped out to answer the question, what excites me, what are you scared about? What excites me first is that I think impact investing as a sector is fundamentally massively increasing. We had this morning a discussion under the tutelage of John Denniston, and he aptly explained that it's part of our lives. It's already here. And I would venture to guess that within a couple of years there's no impact conferences anymore, because impact will be simply part of the DNA of all conferences and all investments, because consumers want it, investors want it, not only the inputs but also the outputs, right? So that's exciting. We see every day, we get tons and tons of super interesting investment opportunities from all over the world, and it's exciting that it creates so much short-term and long-term results. Obviously, there's also tons of stuff that scares me, particularly close to home. COP26, it was for a lot of people a success, but at the same time, it scares me that we leave the world a significantly worse place than we found it in terms of climate change. It's very difficult to see actually a world happen which is 1.5 degrees or less. It's a very difficult problem to solve, because we have to solve it not only as single individuals but as an entire planet. Hopefully, and this is again the discussion we had for morning, hopefully us as private citizens and the generation that's our youth that has taken up a large preponderance in 5 years than now, and 10 years than 5 years, will sort of demand it so much that it will happen not only from a government perspective but also from a private perspective, from a business perspective. And I'll leave it at that for now.
So I'm curious in terms of supply chain disruptions and evolution. You explained that technology can solve some of those. How are you seeing supply chain, say, problems and opportunities play out in the industrial sectors?
So with supply chain right now, the biggest problem is trucking and materials, a lot of plastics. We ship in totes, so now you got to get your totes way ahead of time. Totes are big 275-gallon plastic containers. And then the supply and demand side, if you don't have contracts with transportation companies, you know, we saw trucking go from 4,000 to 8,000 to ship to California. Now we're negotiating again. So you can end up spending an exorbitant amount of dollars on typical supply chain problems, and in some cases not be able to get the goods to market. You can see if you've watched any of the documentaries or the investigative reporting on what's going on at the ports, where you have 80 to 100 container ships out at sea, which is the most they've ever had. Then the other problem you got is they think you're going to be short about 80,000 truck drivers. So unless you have the ships coming in, the trucks picking it up, and then the stores being open to receive it, you have a hole in the lineup, it's not going to go. You know, we're fortunate on our side because we've seen incredible increases in the chemical industry of a lot of the assets we compete against, but our product is primarily made of water. So, you know, our cost doesn't really go up at the same rate that other companies goes up. So when ZEP looks to formulate new products, they realize now not only can they be more sustainable, but they can actually save money. One of the problems with sustainability and impact investing, you know, years ago I tried to bring a green strategy to New York office buildings, but not one owner of an office building would invest even $250,000 to make his building greener. It's just old school. So the problem you have is, in many cases, to be more sustainable, to do the right thing, and to do something that's going to impact the world, it tends to be more expensive. And it's very hard to get a company to spend more money until a regulator tells them, you're going to spend more money, and you have no choice now. So now you're investing. So I think that's been the slow adherence to a lot of the sustainable initiatives that everybody would like to see, is typically they're more expensive. So if you can come with a either less expensive or kind of flat equation, but you can provide sustainability, that does give these big companies the opportunity to say, look, we are doing the right thing.
Yeah, just going off what you said, the solutions to what I think supply chains are and where we are there. You know, I think at this time we're seeing an incredible amount of ships out of port. We're seeing warehouses bring to the low. We're seeing a high demand for new warehouses, and you know, the whole system is just out of sync. And I think it takes a little bit of time, like you said, for the light bulb to kind of turn back on, and you know, we'll eventually get there. But it's a whole revamping with the job process as well. It's a combination altogether. In terms of, you know, I liked what both of you guys said about impact investing. I think what's interesting there is, like, you know, in 15 years, where is impact investing going to be? You said it'll be within the DNA, but at the same time, we'll have a whole new kind of frontier of impact investing that we couldn't even think of at this point. So I think, you know, whether it will be the metaverse and the new frontier of that, or, you know, new form of blockchain, you know, there's always more to come. But I think at the same time, it is challenging always to get the first person on board. So.
That's true for everything, yeah. I want to come back to a comment you make, John, that it's tough to sell the solution if it's more expensive, and you know, people with a green heart even don't make that decision. But for us, we look at it a different way. We won't invest in companies where returns are concessionary, because if they're concessionary, there's a part of philanthropy involved. Typically, it's a different door for us. So we say, hey, we can only invest in it if it's in and of itself, if the unit economics for the business manager, for the customer, are very attractive. And then we look at it, and then it has an alternative angle. We do invest in our charter. It says we need to have a double bottom line approach. So folks don't need to optimize just financials, but also something else. So for example, it's the reduction of CO2. But at the same time, we only invest in companies that can handle both, that we optimize both at the same time. And I would venture to say that it's because of the impact angle that more and more companies will be profitable, because stakeholders demand that. And in those sort of virtuous cycles, we chose industries in which those virtuous cycle exists. So some of the industries, it doesn't. And some of the technologies, for example, are very far out. If you look at companies like Breakthrough Energy Ventures, they have a very, very long horizon, 10 years plus. And so for them, unit economics might not matter in the short term. But for us, we're more a classical fund. So for us, it matters. It needs to be an exit opportunity. It needs to have positive unit economics. And so to the extent that we can mold that, we have a good impact investment. I understand it from your perspective that sometimes if you sell a service, or you try to convince somebody that he has to do it, yes, it's really an okay product, but it's very green, that still is difficult. But over time, I think more and more stakeholders will demand that. So the customers of a real estate building where they are, they will sort of demand a rating in terms of energy efficiency, for example. Those things will become more important over time.
Well, we were a little ahead, because if you go to buildings now in New York, they've obviously started getting more green. We were maybe 5 or 10 years a little early. So, and on our company, our margins are very good. And one of the things you learn, as you said, is if you can make money, you then can become philanthropic. So by making money, it allows you to then give back. And obviously everybody wants to give back. I think that's why we're all here. Yeah, so part of the investments, the investors that we target are ESG type funds, because we fit so well in the sustainability side, the governance, and the environmental side. So, all of our products are helping other companies become more sustainable across the board. What's really interesting, if you do research on the word sustainable, it's almost like all natural food. Nobody really knows what it means. But there's a lot of definitions. And what you'll find is each company defines sustainability under their own definition. So, we've learned a lot about what's sustainable, what's not. Is a company sustainable, or is the product sustainable? So there's a lot of pieces to the puzzle. But yeah, we're very targeted on the impact side and the ESG side.
I mean, we're going to hit the whole topic in spades tomorrow. Our impact summit being tomorrow. We're going to... Question? No.
I'm curious, how are you guys measuring impact? Because impact's great, but there's no kind of benchmark, or I know there's various consultancies and stuff like that, but there's not a gold standard. What are you guys measuring when you guys look at impact?
Yeah, that's one of the massive issues, right? The industry is in infancy. There's no bench. I mean, we look at 5 different industries with very different types of impact. So in healthcare, we look at better patient outcome, more access to healthcare, right? So you can measure that to a certain extent. And every company within its space will have different outcomes. So we invested in a company, AI diagnostics company in the emergency department. So to what extent are they saving more patients than the next best option? That's the delta they generate. You can actually relatively, I wouldn't say relatively easily, but it can be actually implemented in a dashboard, right? As long as you have the conversation that you implement it in a dashboard, and then over time consistently measure those outcomes and look at those outcomes and compare it. That's something. But obviously there's it's in its infancy. ESG reporting is in its infancy. There's no standardized approach yet, and every sector will be different. But we look at it from company to company. We start having the conversation before we make the investment with, okay, so we understand the financial metrics typically. What are your double bottom line metrics? How are you measuring those? What are you doing to optimize those? And we continue the conversation from there.
I heard from one fund manager you can almost make ESG out of any investment, so I don't know.
I think what you have to do when you're looking at impact is you have to look at the microeconomic side to it, because no one has really figured out the macro side. The macro side is a lot of people talking about we're doing great stuff for the world. The micro side is how many more people eat, or how many lives have you improved, or so you can look at it little pieces at a time. I think it's still hard to judge in a big scale because, like you said, there aren't a lot of metrics to really judge against. But you certainly can look at it, one small step at a time.
This is Mr. Industrials here, so.
We do have some industrial assets, but how are you guys dealing with supply chain matters in the COVID recovery here? Because it would it would seem like that would hurt some valuations on industrial properties, but you got to look at things pro forma down the road. So yeah, supply chain.
Well, for us, for a lot of our companies, we're now we're now doing wholesale sourcing, and now that our biggest whole objective is to get all the matters in place, so we're not facing any type of delayed timelines. I think especially for a few of our A&D companies, where the parts need to be at Boeing or at the GE plant right away. It's important to have those parts in place, and I think what we've now been adding into our system is now we've been actually wholesale sourcing from various countries, not only China now, and now we're trying to really just get around the problem. So, how about you?
So just-in-time inventory is very challenging during a supply chain dysfunction. So you have to plan way ahead. Maybe you have to carry a little more inventory than you typically would carry, because you got to make sure that you got to plan on something's going to go wrong, right? So your bottom line can get hit a little bit because you're carrying more inventory, you're planning way ahead. Now the advantage of planning way ahead is you can negotiate better rates in many cases, right, if you extend yourself out. So depending on the size of the company and what they're doing, I can guarantee you, though, that the supply chain has now once again become a primary focus of every major industrial chemical company in the world. That's the first thing that happens in the management meeting.
It's a variation, because Rob, I asked about supply chain when you were practicing your ping pong, but can you talk about reshoring as it hits the industrial sector? The reshore movement, are you seeing, we're seeing in pharma, some parts of consumer, are you seeing reshoring? Peloton may not have gone to Ohio in years past, but are you seeing that as a factor in any of your investments?
Well, for one of our companies, actually, Wisconsin Pharmaceutical, we're now trying to do a roll-up or more per se, and we're trying to, and those are all American brands really, and we're trying to take more small and mom and pop shops and trying to, because of reshoring, we're trying to bring them up into the Midwest and try to bring them all together. So I think it kind of brings it, reshoring, we've been really concentrating the American market already, but I think with reshoring we're having an extra emphasis, and then you're also seeing those small companies now be getting more attention and for kind of a roll-up type of situation.
Go ahead, Eddie.
So one interesting example in the European cannabis industry, medical cannabis industry, there's no consumer cannabis in Europe. They imported, the UK company, they imported the big Canadian American brands, and lo and behold, it was very significant supply disruption, which is not great if you're a patient. So they decided to, as of early last year, when the pandemic hit, to try and basically make their own brand as alternative, and that was the only one that was available. And luckily, it was a very positive experience. And now they sell privately. It wasn't their intent to do, but as a result of that, luckily they were able to sort of create a private label out of this. So make something great out of something that sucks badly. Let's drop it.
Do you have one more question in the back? It's okay.
So in terms of the supply chain, right? Why do we go all the way to China and Vietnam? Why can't we just focus, say, in Mexico or even Central America where they need it?
Did you hear the question? No. So the question was, why has a lot of the supply chain gone to China rather than Central America or closer places to manufacture? And I think that goes back to decades ago when we saw a lot of industries, from the computer industry to manufacturing to clothing, move to China. And the problem is, once an industry moves to China, the infrastructure goes with it. So it's very difficult to bring that infrastructure back And that takes time, and you can see that happening as we speak, as a lot of manufacturing from U.S. companies have either pulled out of China and gone into different parts of Asia, or have started going, as you said, to South America. And I think you're going to continue to see that, because we've realized now that if you have a broken supply chain all the way to China, people might not get their toys under the Christmas tree this Christmas, right? No doubt about it. It definitely has advantages from a sustainability standpoint also. So, great point. But I think you're seeing that movement take place as we speak. But it'll take, once again, it's something that's not going to happen overnight. It's going to take a long time. Thank you.
So, thank you. So we're about to move into a series of breakouts at 4:05-ish. Well, you'll have all, while you have that here, it's all on the door. This, as well as a map of the 8th floor and the 3rd floor. Oh, Brianna's here. You gonna walk us through it? Actually, let Anand kick it off, because we're sort of in Anand's house in a way. Anand invested in Primary, and it's had a roller coaster, but we're helping. We want to help it move up, and I think it's a win-win for our community and for Primary. So, and then from there you could pass it up. And their staff is like, or their team is like rock stars. They are rock stars. So thank you.
Thank you. They are rock stars. So Primary is a co-working space co-founded by the first employee of WeWork. Her name is Lisa Sky. She's the reason why the staff is so awesome, because they're all a reflection of her hospitality. And basically, I'll just give you kind of quick points. So Bar Capital is a participant in this entity because we wanted to form a community, especially around the cannabis and psychedelic space. So we are going to be setting up a set of office spaces, mostly on the 3rd floor. This is the 8th floor kind of layout for events and bigger gatherings. There's another floor that's very kind of zen and peaceful. They have a studio and really nice showers, so you could basically live here. Have you had anybody try to live here? No. Don't. Yeah. It's open 24/7. Yeah. So we're basically inviting verticals to set up communities here. Myself, as an investor, I started to be interested here just purely as a user, but then I noticed the companies that have growing office space needs are pretty good investments, and I've kind of followed that thesis in the background, and now we're going to do it for some of the verticals that we're focused on. Just a few things to also note for tomorrow. We have bathroom codes and Wi-Fi passwords in the front in case you didn't get that already. And I'll just mention also that if you are looking for office space, there's a number of options. It starts with this room. It's not usually set up this way. There's usually desks, kind of library style. And if you just need a place to park and work off of, and you don't need privacy, you can kind of go for that plan. There's also 1, 2-person, all the way up to, I think, 35 or 50 people office spaces available between this floor and the 3rd floor. And for the kind of 361 community attending this, there is a discount. Happy to discuss that. It's a 50% off if you sign up in November for the first 2 months, and I think 25% off if you sign up by December 31st for the first 2 months. And you can quote Bar Capital to get that discount, but I'm happy to go over that in detail. Sorry. I didn't pick the rooms, but yeah, we'll see. I guess that's where I'm supposed to go, Cedar. So if you have any other kind of questions, let me know, but I'm going to pass it along, and you can go to the breakout rooms.
Thank you. So those who would like to go to one of the breakout rooms on the 8th floor, find me. I'll have my hand raised in the front. I will... Hi guys. I will be in the front by the front door, and I will direct you to your rooms. And then we have Melanie, our community manager, who will direct those who would like to go to a breakout room on the 3rd floor to the 3rd floor, those conference rooms. So just find us by the front door. Thanks.
Just last technicality. So at 5, again, we'll come back, and for each of these breakouts to here, for each of the breakouts, there should be 1 or 2 people that will summarize the key takeaways. So, and what I've done is I put emerging markets basically into one group on Oak. And then Europe, you can learn about the Ohio story. And then by asset classes. And then we switch cannabis all the way down to industrials. And again, just sort of designate one or two people to share what the takeaways are. And that's we'll do right here. We'll have all have probably a drink in our hand, talking about takeaways and then networking. And then we'll have some wine and cheese and charcuterie, and then go 4 blocks away, 4 minutes away, probably 4 blocks to Route 66 Smokehouse from 7 to 9. All this is on the door outside. We'll keep this up here as well. And I'll be moving around. And there's people on Zoom. You can easily move yourself to these breakouts. Give everybody about 5 minutes. And somebody in the room, please open a device. There's a screen that connects as well. And I'll be moving around to make sure that the technicalities mainly work. So, and if they don't work, just use your device. So thank you. This is the messy, magical part. Everyone introduces themselves, a little bit of content, takeaways. And part of the takeaway is like, what events do you want to have in those breakouts, those subjects? So, thank you. Enjoy. See you at 5. Take a seat. Take a seat. Tomorrow I'll have my full team. We'll make sure that all the breakouts actually happen. Mine Zoom.
I'm still live.
Yep. Okay. That means I'm on Zoom. Close the rooms.
Yep.
All right. All right. Good. So I wanted to do. It's this it's our. All right. All right, come on in. All right, so Angela's going to start us off. Even though she didn't have a breakout for the sports community, she's going to tell you in 60 seconds what she's going to do to mobilize the sports community. That's right. All right, come on in. You want me to visit LA? Yeah. Okay. On the 11th. We're going to do a big shindig Friday night of the 11th.
What's this?
On February 11th, before.
February 11th. Oh, yeah, right before.
Right before.
Right.
But broadly, introduce yourself and what we're going to do with sports.
All right. I love how Mark just put you on the spot. Hey, everybody. My name is Angela Gorin, and I'm here from Canada, but really excited to be here. I'll be here all day tomorrow on a couple panels, but as Mark just mentioned, I'm opening, I guess, the town hall and reception. I am the founder of Tap & Go Technologies. It is a fintech and an insurtech. We specialize in vertically integrated bank products and features directly into the marketplace. But more than that, I guess, as Mark kind of learned and knows from the Ohio trip, that's where I got to know him. My background is an Olympic athlete, and I'm still a pro cyclist in my final stint to almost retirement as I go after a world record on May the 4th in Aguascalientes, Mexico, chasing the clock for an hour. So excited to almost retire in that stitch. But we're excited with 361 Firm to be starting to create a sports vertical. So some of you are going to meet tomorrow a former New York Giant. Charles Way is going to be joining us. Of course, Jack Wyant is unable to join us due to a family circumstance. But of course, he's the owner of the Reds. So we've got the the MLB, but we are excited to be looking forward to putting together a symposium that's going to happen before this year's Super Bowl in Los Angeles on February the 11th. So stay tuned, but definitely as we start to talk a little bit more on our breakouts every single week with the 361, you'll start to see myself and the crew growing. So if you're interested in sports media and entertainment, I'm going to take the lead on that with Mark and a couple of others. So please reach out and come say hi to me at any point in time. There you go.
And you're doing something that's also impactful, right? For tomorrow, let's just touch on that real quick.
On which side? Oh, on my Oh, okay. So I guess, yeah, a little bit more on Tap and Go and what we do. So I got into the challenger bank or the neobank space out of purpose. So for myself, I'm very endeared to impact investing. And I saw a niche a few years ago, like I think like any entrepreneur, a problem to solve. And I was really curious on how people transaction. We all pull out our cards all the time. So what I thought was really interesting was being able to create a blockchain or an AI that authenticates who the audience is and directly put that into payments. So kind of flipping the engine a little bit, because, well, I'm somebody who loves sports and athleticism, but you might be somebody who's a female founder, totally different market, or you might be somebody who's a youth. So I started to really dissect what was the process of a lot of these neobanks, and really at the end of the day, it was all about transaction history and data, but they were not getting anywhere. So for me, it was about authenticating who that user was. So we're really excited to be launching our first flagship program, Athletica Rewards, Athletica Protect, because we do have an insure piece to it, but it's made up of great brands and organizations. And for us, it's really looking at Q2. We are also the first challenger bank or neobank out of Canada to be licensed both in Canada and the US. So there you go.
Thank you. And I met her via email when she says, I'm crossing the border, but they may not let me in unless you show me, if you could feature me as a speaker at your event. That's how we roll. Okay, so so that was a sports breakout that didn't happen, but that's actually how this whole thing started. Courtney's from Denison, and I came back from Moscow, and I tried to have an event for students, and I mentioned the word alcohol. And the school would not give me the email addresses to the students. So I went rogue. And I continue to go rogue, and even went rogue with University of Michigan, because there's a fault. I'm sorry, John, I know you love University of Michigan, so do I. They always ask you for money. My rule is you come and help. Don't ask for money. Help, they give you money. Anyway, that was my thing with Denison. So this whole thing about roundtables all came from Denison connecting and doing all this stuff. But the first year, I said I was going to do it, and I didn't do it. So we had a sports meeting today. We tried to do it. We're trying to do it. It's going to happen. That's just how this whole thing rolls. So now let's just go to the digital assets group. Actually got together. Who was in the digital assets breakout? Erica? Well, there were like 4 or 5 people, or 6 on the Zoom, or 7 or 8, but can you speak to that? Well, you guys could both come, and you're both coming up right now. Let's come. Jacob, you too. Introduce yourselves. Yes. Neobank. No one even knows what a neobank is here, half the people. Sorry, you guys do. Go.
Hi, thanks everybody. I'm Erica Lill. I'm out of Seattle. I've been crypto trading since about 2014. Dealing with a lot of companies and startups right now, including International Crypto Exchange, e-gaming, sports arena that will be built out 32 strong. I'm working with a luxury Airbnb where we're going to take crypto as a payment. So big variety of things. We had a good conversation in the back, and I think I'll hand it on.
Hello everyone, Jacob Lebo. I do have some crypto holdings as well.
I'm not very good with the mic. I project, so I should have had my career on. So you can see, Jacob. I can see. Yeah. No. I advise a blockchain exchange, or crypto exchange out of Abu Dhabi, Mubadala backed. I'm going out there next month, so that's pretty exciting. But we really spend a lot of time talking about the actual utility of NFTs, of crypto, and really some of the not gamification, some of the, what would you call it? I'm gonna let Spencer.
I think what was interesting that we talked about was both the existential part of it and then sort of the practical of like how does crypto change behavior based on technology or based on what it actually is, and then the existential question was, is the changing of behavior enough for it to change sort of institutional access or just how things work, or is this we're rebuilding these systems we already have? And I think that was sort of a very interesting existential discussion that we had about systems and behavior in the crypto space.
Well said. Crypto is existential. Yeah.
Yes.
So is everybody holding any crypto, or are there people, everybody's holding it? Curious? Not major, but just
enough to like track it.
It's coming.
But we had Sherry Witter today made a case that this is impact, and she was very passionate. You guys are all passionate.
There.
Kool-Aid, but they view it, I'm just having to track it. But I'm a little skeptical.
I think impact could be happening when you talk about banking, bringing more people into the financial system. We had a lot of breakouts on Africa and emerging markets, and the billions of people that still don't have access to financial services because they're just not, their needs are not being met. I think D5 holds that promise from an impact standpoint, right? Financial inclusion.
And then it's that umbrella of blockchain, DeFi, and crypto with betting on and
you just have to take it as the asset class or the applications, right?
So I think it's really important for people to be able to differentiate between blockchain and crypto itself. Yeah. Not all digital assets equal to cryptocurrency, and not all digital assets equal to having to use cryptocurrency. Blockchain has, or distributed ledgers have a lot more use cases than just what cryptocurrency has. Whether you're using NFTs to track royalty payments and not use, or you're using it for land registry purposes. There's so much more to it than just the crypto side of it, and there's so much more impact that can be made. Think of it this way, and I was talking with someone a little while back about this as well. The first mobile banking or mobile payments application was developed in Africa, not in the U.S., not in Europe, but that came out of necessity. The most advanced mobile payments system other than China is in India, purely out of necessity, to bank the underbanked. There's so much more of an impact aspect to using blockchain, to use the immutable ledger, to use the smart contracts for the instantaneous transactions. Crypto is a very small piece of it. If we use it in our company, that's the underlying tech that we use. It's the more easier the user adoption becomes, the more easier the user experience becomes, the more widely you see it adopted. In my opinion, blockchain is the future for a general purpose. It's like the internet of the future, where crypto is just one aspect of it. In early 90s, how many people would have thought that blockchain was going to have a business? Not too many people were affected. Or you would barely have any Barnes and Nobles around and have Amazon selling all the books. It's a similar way where adoption on the blockchain side is significantly higher compared to adoption on the internet side if you compare the time frames on. 11 years into blockchain, you've got far more adoption compared to what internet had.
I know what you can put the genie back in the bag. Go ahead.
You mentioned India and mobile payments. How much has that led to formalization of the economy versus informalization? So I posit this to a lot of economists in emerging markets. So the question is this. So he mentioned mobile payments in India as a necessity, and underbanking in emerging markets where I live is a thing, right? How much has that led to formalization of the economy, do you think?
So in the subcontinent, the economy gets formalized based on these micro banking facilities that happen, right? So while the underbank is still not being used are still not using a formal bank, there's there's this one product that's called the Easy Pesa program product, right? So the Easy Pesa product, Pesa being a penny, the product specifically is for people to go put money, give 100 rupees or 200 rupees to a retailer and put money on their mobile account, and then they can transfer money from me to you to the third party person. So it's become a lot more traceable and transactable. And this is a product by Telenor, which is a Norwegian telco, which is not just in India, but also in Pakistan, but also in Bangladesh, and also in a lot of the African countries as well. So while it may not formalize formalized banking per se, but it does offer a lot of traceability to it as well.
In India, though, they were forced to do it. Right in India, they were forced to do it because my friends have to pay their servants through mobile payments.
So as those payment systems became more and more adopted by the underbanked, you're talking about paying the household help. When you go to China, you've got your beggars with a QR code for their, what is that, Alipay or their WeChat QR code for you to give them money. So forget about household help, which is more formalized. When you have beggars asking for mobile payments, that tells you how advanced that becomes and how much you're banking the underbanked from that perspective as well.
Couple of things about India. So I noticed the talks today that it was sort of missing 1.2 billion people, fastest growing economy, equity sector pretty much racing ahead. And this is not a advertisement, I'm just giving you basic facts. Couple of things on the mobile payment system. The significant driver of mobile adoption had to do with identity protection. So Aadhaar, which was established in India through Infosys, was enormously successful in getting everybody to verify who they are. That's number one. Two, Paytm and other systems, yes, they do use blockchain, but there is made in India technologies that they've sort of layered on that work really well, okay? Number three, GST. So the taxation system until very recently was very fragmented. And so the government decided to basically put a universal VAT that has also helped, which uses the technology you're talking about. So the answer is complex, it's layered, it's a big country. Yes, the government did a few things, but the adoption of critical technologies is the fact that the population wanted it, you know, and they're really good at it, and the population's really young. So anyways, just a few points that the Modi government and others since 2014 has really, I mean, GST made a big difference because when you have a universal tax and universally shared across borders, and no, like if you drive a truck from one state to another, there's no tax that you have to pay at the border, kind of a big deal. So you're right, yes, blockchain was a part of it, but it's not the total story.
Oh, no. So I'm not saying that blockchain is a part of the mobile payment system. What I was talking about was how mobile payments.
Yeah, no, absolutely. But adoption is country specific and cultural, okay? So that's a big part of the story with mobile in general. If the culture is adaptable to the technology, then it will work. You can't force something. And it's decentralized. That's the other thing, too.
Because it's solving a problem, right? So mobile payments solve a major problem.
That's the only point that I want.
This is what Mark wanted. He wants some fiction.
I'm done.
That should be.
COVID really hit, right? Everyone was so bullish. India's going to be up 12% GDP, and it really took a hiccup. But this is the great thing. This is why. This is the messy and magical. Sorry, go ahead, Jai.
I love asking this question, and I've yet to get an answer that I'm truly satisfied with. Not to lead the witnesses, of course. You know, it's my sense, okay, that the regulators, at least in some countries, some parts of the world, let's start with the United States, don't get this whole crypto thing, and I don't like that word crypto. My son says it's cryptography. I said, no, I think it meant something else. Okay, like hidden, sneaky, sub rosa. In any case, I prefer the word digital assets. But I don't think they fully get it. I think the IRS has figured out how they can tax transactions. The SEC is sort of, coming to the conclusion, well, this is a commodity. Others saying, no, it's not a commodity. I don't know if that's been settled yet. But what concerns me more are the monetary authorities in major countries, OECD. How will they be able to affect monetary policy as they've always been able to do so? And I wonder if a knee-jerk reaction won't be, why don't we kill this and we create our own currencies, if we have to have some kind of digital currency to solve problems such as those have been solved elsewhere, and have a universal global digital currency. So I don't know if that's a question or what, but if you could comment on my comment.
Yeah, I think when we talk about like the existential part of this, right? Like, the existential question is, it's a really tough thing for governments to interact with, because you said, why don't we just get rid of this? Well, the truth is you can't, right? It exists, for better or for worse. And that's like what the technology causes it to exist ineffably, and then the behavior around it is the question, right? And that's sort of the fundamental thing here. So governments have a choice to embrace it or push against it. I would say that I don't think governments who are pushing very hard against it are having so much success doing so. If anything, they're just driving capital off of their ability to track it. And I think if you look especially at what the U.S. government, it's partially a jurisdictional issue of like who wants to be the one regulating it, right? But then the other bit is if you just tried to ban cryptocurrency, right? Like that's a really bad thing, because you want to make systems that people agree with and not systems that people are actively trying to go around. And I think the next few years will be a big question of, are governments going to actively engage with and participate in what's happening, because it's happening regardless if they do or not, or are they going to try and push against it? And I think the vote's still out, especially in the US you have Miami and New York, obviously the mayors are trying to be crypto friendly, and then you have other places that are less than that, right? And so I think it's still uncertain.
So it's a little balkanized.
So this is just one area. So I just want to we'll pause, and I should show the slide that shows the calendar, because we have in process and on deck, and this has been on deck for a while. So I would like for this to catalyze a deeper dive. And if you saw this calendar, you would see there was blockchain, DeFi, and crypto, because people do identify with those three buckets. So I'm curious to have all of you be part of that 1, 2, or 3, or all the above. So thank you. I have the wrong, because we're still debriefing, so let's just keep going. Cannabis we know is important. Anand is reading his phone, but you didn't really have like a full-on breakout, but maybe you could speak to it.
So on the cannabis front, just at a high level, I think what's happening now in the Midwest and East Coast is very interesting. Obviously, New York and New Jersey, being old school political places, haven't figured out their ducks, because they're wrangling and they're figuring out who gets what part of the pie, and that's going to continue. But it's going to happen, and it's going to become the corridor of the East Coast is going to become one of the biggest markets, just like California's a state that just covers the whole West Coast, so it's obviously going to be the biggest market, but the East Coast is happening. One of the key things, I think, it's part of a lot of the discussions, and kind of Bard Capital gets involved with the advisory and the capital side, is how do you take the lessons from the West Coast and not make the same mistakes operationally in the Midwest and the East Coast. So there's large players already in play. They're going to do well because they have capital and scale, and the MSOs are doing quite well in trying to create monopolies. But to create an actual industry, I call it the dirt road system right now. I come from India, so I'm allowed to say that. You've got the dirt road system right now in cannabis. It's just really messy. There's no real efficiencies. to create the highways to exist, to properly supply the demand that is already starting to show up, is going to be the next kind of play. So I'll just mention that for the cannabis side. And I usually don't drink, but I'm going to enjoy the wine right now. Okay. You have a comment or question? I'll just bring over my mic.
So I think the larger question is federal legalization and the roadmap of when that may get established. We're not quite clear. There is a Republican member from South Carolina that's proposed some things that may get some traction. We're not sure. A lot of this action can be done by executive order, but neither. I'm not going to get political, but it hasn't been done so far. I think I would call the cannabis market from a capital perspective bifurcated, where you have maturation in certain states, both in terms of cultivation and grow operations and also processing, and that needs to get integrated over time, and there are only a few states that allow both. And I think the decriminalization aspect from a social equity perspective is really important. I mean, they've got to do that. Illinois has done a really good job, and so other states need to step up and be able to remove infractions, especially from many, many years ago. I think the cannabis story and the social equity story should be weaved together, and it's not necessarily talked about. And if we're really going to talk about impact, clearly this sector has a potential to do that.
I feel like what I really need to do is get you, Anna, involved, because we have all this content. We've talked about all these things that he's talking about, but we don't get the word out. You talk about indexing and digitizing, and then we've transcribed, but we haven't let it out because my broker dealer has been very careful over me. So, but we've hit all these subjects. We're going to hit it hard. Right? You want to talk about that?
Yeah. So social equity, just to comment on that, I think it's just a buzzword for a long time, and the problem is minorities get to win licenses, but they have no capital support system, they have no operational support system, they have no service provider support system. So we've seen quite a few interesting models. One of them out of Michigan, which I can't mention the name of, but they basically have worked with the progressive, and we saw this in the Midwest tour that 361 firm did, about a month and a half ago. They're basically creating a franchise model with a training program built in, so that the cultivation, the store operations, all of those things are taken care of at a scalable level. What I would love to see is the government in these states, and by the way, federal legalization, I think, my thesis is it's not going to mean interstate commerce, because New Jersey is not going to want California cannabis coming in for a long time, because they want their tax revenues, and they want to keep that captured. But in the social equity side, I think the key is going to be, how do you give alignment, and how do you provide cheaper financing? There are a lot of vultures that provide debt financing in the cannabis space, right? So if the government can, like Israel does or other progressive kind of governments do, provide 5% debt financing if you're part of this social equity program, so at least your capital cost is taken care of, and you can be competitive with an MSO, which can get much cheaper financing than the average cannabis company. That's going to be another key component. So we're actually working on a lot of these ideas and communicating, but I think the federal legalization side, it's going to take a while. I think the biggest things they can do is decriminalize and let a lot of the folks that were imprisoned wrongfully out. But then how do they get jobs? So tomorrow Charles Way is speaking, and I've had a whole conversation with him. He's more involved in the real estate side, but how do you take a social equity angle and then partner up with the real estate players to build out a small business community in these, these communities that were otherwise very much persecuted against in the because they have a lot of strong emotional feelings about that. So any plan you come to them with, it has to be the right structure, and they have to have ownership.
So I want to talk about venture, because some people have to leave and they don't really appreciate ping pong. Me too, sorry. All right. Well, you're a segue to venture, so right? Among other things. Well, I'm
sensing that some people want to have dinner and then go to play ping pong. We'll find out. But this keep it going. Go.
So we had a really interesting conversation in one of the breakout rooms downstairs talking about valuations and how that impacts venture and ties into D&I initiatives. So something that, I'm Neetu, if you don't know me, and I'm one of the GPs at Unmatched Ventures, along with Shane and Spencer, and we also have Mark, who's over there, who's part of our team as well. And something that we've tried to do at Unmatched is invest in underserved regions and underestimated founders. And what I mean by underserved regions is basically not the Bay Area, like looking beyond the Bay Area, looking beyond New York, and looking beyond Boston. That's not to say that we don't invest in these regions, because we do, but to have a more holistic approach. And part of the reason is that your dollar goes a lot further in the Midwest and the South than it does in these regions. And also, venture capital has been very much like closed off, and I know there's a lot of funds like Andreessen and some others in the Valley that kind of only invest in the Bay Area and don't even look at companies from Kansas, Indiana, Ohio, even though those companies have really good metrics. So when we're talking about valuations, and especially about how valuations are lower in these regions, there's also something else that people don't say out loud, and the fact is that companies are founded by women and companies are founded by minorities also have lower valuations. And part of that is just like the systemic system that our world is based in. But something that's interesting is when you want to kind of get the best ROI, and there's some people that only care about that, only care about those sorts of metrics, but there's others that also want to make an impact and use capitalism as a force for good. And there's a way to tie both of those in, because if you're investing in women and if you're investing in diverse teams and underestimated founders, including veterans, by the way, veterans are a group that is not often talked about in the diversity argument, but they're a huge group. If you're investing in them as well, you will get very strong ROI. And McKinsey, Harvard Business, lots of other things have shown about valuations and how this can be beneficial. So that's kind of like one of the main things that we were talking about. There are a lot of other things as well, but I just wanted to also make a point to Anand and what Anand was saying before about cannabis. Something that I think we should look at is also the interplay of fintech and cannabis and how those two kind of intersect. So when I was at Alumni Ventures Group, we did make one cannabis investment, and that was for a cannabis fintech company, or a company that will provide banking for high-risk industries. One of them could be cannabis, another one could be gambling. And when we were doing our selling, B2B into financial institutions, a lot of the financial institutions were scared about cannabis, and they would run in the opposite direction. But when we mentioned that it was cannabis fintech, it was kind of a wedge to have a conversation with these institutions and with these banks. So it might be using cannabis fintech could be a wedge in to get people more comfortable with the cannabis industry. Yeah, of course.
What I've noticed in the last 6 months to a year is I think there's a lot more openness towards women founders and women, founded private equity groups.
Yeah.
And I just came back from Dubai, and there were a lot of women who were raising their private equity funds and impact funds, and it's a totally different scene. I'm talking about in the last 6 months to a year than it was before.
Yeah, I think in general, some of those organizations, I'm part of 100 Women in Finance, and I think those are very beneficial. I think also with regards to underserved regions as well, and just the entire underestimated conversation, everything going remote, the future of work and everything kind of moving remote due to COVID has also helped, because now companies that are based in Kansas and Indiana and Ohio aren't necessarily disadvantaged because everyone's meeting remotely. There's no real advantage to being based in, Sand Hill Road or in New York. As in-person meetings come back, we'll have to see if that holds or not. But that's something I noticed from COVID, a silver lining.
Yep. Just on that quick thought there, there is significant difference between, let's say, the Boston or the Sand Hill Roads or, areas of incubation, and a little bit of the challenge. I'm a big proponent of diversity. We had 700 jobs in Africa that we commercially were able to exit, and it was a win-win. But where I'm coming from is policy and politically, every community is not the same. And I think to the extent that you make a difference of diversity and touching with an ESG, in some of the tougher states, like in the South, or that don't have that critical mass, you're going to have a force multiplier there of effect. So, I think it's important to be inclusive from not just where it is easily easy for incubation, but to areas that are going to be kind of a little tougher, but the reward is more meaningful. What are your thoughts on that?
I also thought the same thing, just coming from a background of someone who had worked in California and London previously, but I was at a conference in North Carolina in the Raleigh-Durham area actually, and we had really eye-opening, great conversations about diversity and what it meant, and like how diversity of thought and diversity of background and how important that was. And I found that people were receptive across state lines and across political lines. It wasn't really a political conversation or like anything about that. So I was very surprised in a positive way. So I think looking forward, as long as there can also be shown a strong ROI, which I think there is the data to show that, and especially if you take in the valuations into account and you're looking at things like that, I think it's a conversation that can happen there. It's like, look, we'll make you money. Here's how we're going to make you money, and then here's also like something else that we're doing that's beneficial. Yeah.
By the way, I'm going to make a plug for Route 66. Not only Smokehouse, but Chicago is where Route 66 starts, and it goes through the country. My dad did this on a motorcycle. Yes, we're going to do it. But we're not going to stop at every little town. He had sardines and he had camp. You're in? Okay. But there's a lot of value. Just because I'm from a small town in Ohio and I race motorcycles, and there's, it's coming back. There's some really interesting things about what you've pointed out. Like and no one, Sequoia only wants to invest where they can drive to, right? Blah blah. So there's a lot of opportunity. There's so many headwinds and tailwinds happening right now, right? And the tailwinds are really interesting for democratization. Someone was saying that the cost of starting a company today, right, and all the rest. So, yeah. And then what you really need is not to screw up, not to invest in things, and that's why you need a community, because you need to have the ability to know who's invested. So Jack Wyant, where most of it is like, for right or for wrong, he may be wrong to invest in you, but that's a plus, Yeah, sure. From a tokenization standpoint, you get token points from Jack, right? And all the rest. So I wanted to if anybody wants to speak, but I want to give you a few teasers about tomorrow at least. I did not do the breakouts very well today, but that's fine. But tomorrow we will. And I would like for John to say a few words. He really nailed it today. So, and I know human trafficking, maybe just you could say a few words. And Sam and Cedric about Chicago, South Side. Call it the initiative. It's really about opportunities in all these places. So, quick, if you could.
Thank you, Mark. Honored to be here. Here was the deal this morning. Why did you give me that look? No, because I'm going to tell people what you really did. So that's why. So here was the situation this morning. Mark said, okay, I'm supposed to talk about the history and the future of impact investing. Hold it. In 7 minutes. Okay, I was given 7 minutes to talk about the history and the future. So here's a teaser. So tomorrow Mark asked me to do the keynote at 1:15 tomorrow on impact investing, a little bit more vague. So I'll be more expansive tomorrow. Here's my teaser. I'm going to talk about, I gave the commencement address at the University of Michigan Economics Department a year ago, and I had to come up with an economic insight. I'm not going to tell you what it is right now because you got to show up tomorrow. So, but it is, in my opinion, the most sudden and dramatic market shift in the history of capitalism. Okay?
Build up.
It's my opinion. It's my opinion. Okay, people can have different opinions. This is New York, right? So I'm also going to talk about the paradox of the 70s and the 2% solution. Last thing, I'm going to talk about Adam Smith. The invisible hand, for sure, but also he was a moral philosopher, not just a political economist. So invisible hand, greed is good. We'll talk about that a little bit, but we're going to pair that with his teaching on the path to human happiness. Very different. So there's his earlier book, A Theory of Moral Sentiments, directly addresses the question of what is the path to human happiness. So tomorrow, that's a teaser. I'm not giving answers. I'm just asking questions. Yeah, well, and we'll talk about the 60s too.
Mark, I saw a comment by Jack Ryan on Zoom chat.
Recent or 15? Oh.
He heard you.
Okay. What did he say?
I couldn't help, but I'm just letting you know.
Gary, what did he say? Oh, I mentioned Jack's name. It probably that came up. Jack, we love you. Jack, we love you. So that was a great teaser, John. Let's say, Jaspreet, can you maybe speak just, Brett, come up here maybe for a second?
Don't fall in. I think, no, that would be good. I can walk up there. Does this work?
Speaking of Chicago, that's where we met.
Hello. So for those who don't know me, my name is Jaspreet. I'm the CEO of Win This Fight, a non-profit organization to fight human trafficking. And my background is from fintech. I think a bunch of you have heard the story, so I won't bore you with it. But I got involved with this non-profit because I was already building a fintech on how to go after human trafficking by actually going after the dirty money from a very fintech angle, and I ended up getting very deep with him on the nonprofit side, so we're actually doing it all together. So, but tomorrow is not talking about us, and we have a fantastic panel. We've brought like 3 experts from around the world, very high profile. I'm not going to disclose who, you might have read their names, but super excited, but they also want to work with us. And one of the organizations there in particular, which is attached to a major royal family, has taken notice of us, which is still a baby organization. And the reason they have taken notice of us and want to work with us is because we literally have this, I don't want to say we have the most innovative approach, sounds a bit not all that humble, but we literally have a very innovative approach to actually make a measurable impact. Somebody was asking earlier that when everyone talks of impact, can you measure it? In our case, yes. We can say that you remove this much money, how many lives you can save.
Of ours, I don't know if Cedric's around, and then you can be the spokesperson.
Thanks,
I think
Mark.
there might be Lauren might be around. Lauren's always around, by the way, but you just always pretend like Lauren's on your shoulder.
Always.
Yeah.
Always. So thanks, Mark. And Sam Cashy from Chicago. I won't be as elegant as the previous University of Michigan alum because I went to Michigan State and all we did was win this year. But let me talk about Chicago briefly. My microphone is off the chart loud, but so tomorrow you're going to learn about a team that's really looking for partners to amplify and accelerate what's already happening on the ground. There's already a lot of momentum that is in place. And what we brought together is a team that wants to be a concierge partner to interested investors who want to look at the third largest market in the States and what's going on. What are my opportunities? How can I make an impact to a community that some of the headlines are good, many are not today, but the potential is there. And these are shovel ready. These are things that are already happening. And so it's going to be a multi-industry conversation also. It's not just going to be one facet. There's going to be discussions around real estate, around light industrial manufacturing, around technology and cannabis, which is now recreational and adult use in Illinois. And there's a lot of momentum there. And so the concept is bring you a panel that will provide like ground level insights of what's already happening, and then where are the gaps for really turning what really people are working hard on to say, okay, let's give them the capital that is needed. But part of our solution is going to be a team that's going to help you vet based on local expertise who's going to be able to kind of follow through on those investments and actually coach and nurture along the way, because the best. Oh, okay. So this is an important kind of part of our tour, because we actually got ground level through 361 and went through the community. And I don't know, anybody here from Chicago? So every locality has their established neighborhoods, their comfortable neighborhoods, and their neighborhoods that have been left behind. And especially when you get in a major market like Chicago. And the south side of Chicago, from like McCormick Place, which is just south of the city, basically to like Gary, has been one of those neighborhoods that has all the potential and like really none of the ecosystem, none of the structure there. And so we got to go around and just meet some like truly innovative, committed people who are professors at University of Chicago, who are doing real estate development right now. And some of the cool things about Chicago is you've got some major employers making big bets in Chicago because of the university system. You've got University of Chicago, you have Northwestern, you have DePaul, you've got University of Chicago, Illinois, and so University of Illinois, Chicago. And Amazon and Salesforce and Google are building large campuses. And where are these people who are going to be younger people, younger workforce people? They're not going to afford Lincoln Park. They're not buying $500,000 to $1 million homes out of the box. They're going to need fun places, and so tomorrow we're gonna paint a vision of an ecosystem based on public transportation, based on proximity, which every real estate investor knows that proximity and location is everything. But you also have to have density and velocity, and so just really looking forward to, and I'm just thankful to Mark and to the team to be part of this and just be a catalyst in this adventure. So we'll be talking to 11:30 tomorrow, and then please make it interactive, ask questions. But this is just the beginning. We're going to kind of create a process to help people who are interested to have a partner to vet. Are you a real estate investor? Are you industrial manufacturing? Are you technology? Are you interested in whatever sector, and help you find value, like the right entrepreneurs, the right businesses. Maybe it's growth capital, maybe it's venture capital, maybe it's seed capital. So thanks, and I guess, am I the last thing between here and cocktails? Or it's you.
Maybe. But anybody still in the Zoom? Just since you're, we have Chicago people on the Zoom. Bruce or Lauren, you want to make a quick comment before we break from Chicago issues? Can we hear him? Hold on, Gary's got him.
Can you hear me?
We hear you, baby.
In order to calm myself down, I'm gonna force you into intimacy and introduce you to my family.
Oh, what's going on here?
This is my grandmother. She turned 96 last April.
Is that me?
Yes, she deserves it. She looks like Queen Elizabeth.
I think Sam has pretty much covered it. I mean, there was so much momentum that came out.
And she knows a thing or two about longevity.
Lauren, is that your volume?
According to her theory,
I don't think so.
We were born with a ticking clock above our heads, an unchargeable battery, and everything we do that exceeds the average of minimum effort we need to invest to live fairly well
it could have been a lot
is
worse,
consuming
right?
our given energy and shortens our lives.
Because I have a 5-year-old daughter, it could have been something else.
His theory is a whole different ballgame.
All right, hold on, theory.
He says that the more you do, the more time you have.
Okay.
being in two places at the same time.
No, I think Sam pretty much covered it. I mean, there was so
His
much
friends
momentum
say
that came out of the
sometimes he falls
the South Side
in
tour,
social gathering.
and what we did
So
there
even
at the
his
Chicago
unconscious
Roundtable.
time
That
will
those
be
of
while
us that
doing something
you know
else.
from the 361 community that were here in
And in
Chicago,
this discrepancy,
were just determined that we
I
would
think in fact
take
we
that
all live
momentum
in
and
this
kind of keep going with it.
And as time passes,
we had
I've
I mean,
realized
the talent that we were able to bring in the room to start, putting this together.
is a major challenge
Yeah, it's
for
really
this
exciting,
generation
and
of course
looking
for the
forward
next
to
ones.
showing it
When I
all
was
to you folks tomorrow.
26, I was hosting a successful morning show on television. I was a newlywed, and I was
Okay.
just about to finish my
Keep
master's
going, Lauren,
degree in
sorry.
diplomacy when I've decided I wanted to try to get into
I think
grad
this-
school.
I
I mean,
got her.
anything else?
Found her.
Anybody have
That
any
decision
questions or anything that they might before
Got it.
we
Keep going, Lauren.
before
We're
we
good
break
now.
from this? Is anybody?
It was
Can
a-
you hear me?
Yeah, we're good. We had a little
Okay.
YouTube parallel TED Talk going on. Keep going. You're good. Lauren, go ahead.
Okay, well, yeah. I mean, that's about all I have. That's about all I have for now. As I say, we're going to have Bruce Montgomery, who is a fierce advocate of Black entrepreneurship here in Chicago. He'll be there. I think Cedric Watkins, who's there in New York now, he's also going to be on the panel tomorrow. Gerald Beecham, who is works with an investment bank here, has 25 years experience in what's going on here in Chicago. So yeah, a lot to look forward to. So looking forward to seeing all of you tomorrow, 11:30.
I just wanted to make a quick comment. There's a show called Home on Apple TV Plus, if any of you have it, and episode 2 is Chicago. And I saw it after I went on the South Side tour, and it's an excellent show. But episode 2 is about a local artist who's revitalizing that area. So,
I'm not trying to put any water on the great fire, but just what we're trying to do. And I told Lauren and everybody, and it's going to start with steps. But like you've heard a lot about Eddie and Jack and others. I'm looking for our community, people that we know and trust that can be underwriters of deals. And they typically are funds. That's where we can back up the bus. So right now we're creating knowledge and relationships, and whether it's a real estate transaction, so Stephen R. Ross, he's related, he's killing it in New York. If there's somebody that we all know that's in Chicago, or and that's just an example, it could be any investment area. That's why I like funds. Funds look at thousands of deals or lots of deals, and then have a funnel and a discipline. So that's why I've been telling them I'm really looking for, could be accelerators, pre-seed funds. I think that's the most impactful way. We're not like real estate. I would never usually think, but I think it's really important for Chicago South Side. So I'm looking for any real estate development that could help accelerate bringing the kind of people that you want, the talent. They need to have places to live, and I think it's a win-win-win. But I'm looking for like accelerators and pre-seed, like the venture community. If we could help accelerate that, whereas Google in the Loop is good because you could feed from the green line in, but to really build a venture community, it could be opportunity zones, right? It could be the win-win-win there, but so it has to be. So I'm just saying, our approach is to be disciplined, not just to be. We love it, but let's take St. Louis, right? We all have I'm Cleveland. We all have our places where we need, and let's all learn from each other. As we, this infrastructure bill that was talked about, you can accelerate that. That's like, I'm not going to call it like congressional gravy train, but we want it to work. Someone was asking this morning, is it really well crafted? Well, it should go to like the best stewards of the Capitol, right? And that's what we all want to be coordinating so that we
can be the best stewards and be impactful and make a lot of money. So it's not just let's go to the South Side because it's a place that needs help. Let's do it in a smart way. That's just, I'm trying to, and I know some people are chomping at the bit to get going, but we make a mistake, then we lose our momentum. Anyway, do you want to say something? Yeah. Okay. Sorry, Lauren, I think you've heard this, right? From me.
You're muted. Okay. So you take a look at Ohio and what Joe was talking about and creating a private corporation through tax base to really accelerate growth. So we just want to share ideas. We don't have all the answers. There are a lot of good people on the ground working really hard who have been doing this for years and decades. And that's who we want to, we're not trying to fly in and say, hey, we have all the answers. We just want to be that concierge and help. Yeah. And I agree with you 100%, Mark. We have to vet the investment opportunity together. We have to vet the entrepreneur together. Who are we backing? Because, I mean, there's no guarantees, but somebody in this group mentioned the one-way ticket entrepreneur. The one-way ticket entrepreneur doesn't have the trust fund, doesn't have plan B. Those are your most likely success stories because they're going to figure it out because they don't have another option. But together, I think tomorrow we're going to talk about kind of what's on the ground. It's an early exposure. It's the beginning of a journey. It's not the end. And so I think, and please try to ask questions. We have a really esteemed group of people that are really informed on what's already happening today. So thanks.
Any other comments, questions? Before we mosey, we get another train, get to the ping pong. There's the shuffleboard, there's like foosball. No. I'm competitive in nature. Yes, I love to try. Yes. What kind of motorcycle did you race? I went to an 80. My dad got in an accident, and we all had that. My mom said you have to get rid of all the motorcycles. But I'm feeling if we can, the cadence may be that we call it a day, and we go from there. So appreciate everyone leaning in, and thank you. See you tomorrow. Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.